In your notebook, write down the heading. Some basic terms before we start practical sums. Just a second. Yes. Some basic terms used in merger. For entire chapter discussion, firm A will acquire firm B. So for all learning, I'll be taking A and B as the example. A is a big company, B is a small company. A will be buying B. Some of this you can copy. This is more like running class note. If you find it very easy and simple, it's okay if you do not copy also. So taking an example, firm A is acquiring firm B. A will be called purchasing company and B will be called vendor company or target company. Another example for easy learning is Zomato is the purchasing company and Blinkit is the vendor or target company. Some books even write purchasing company, selling company. Selling company means vendor company. You can just make a note if you want to. Firm A acquires firm B, then A is a purchasing company. A is purchasing company and B is called vendor company. Yes. Before I move to the next slide, think and tell me why any company is interested in buying another company. What are the possible reasons of an acquisition? Why Zomato bought Blinkit? Why Facebook purchased WhatsApp?
Which is purchasing expecting future benefits of the company is like selling.
So one reason is you're expecting more revenue to flow because of acquisition. Number one. Number two, to kill the competition. Number two, you don't want the other guy to be there. So kind of monopoly creation. Number two. Number three, diversification. You already have specialization in one product. You want to launch another product, but you know there is already someone doing it. Instead of we trying our own hands, let's pay and buy. Also the same Zomato and Blinkit example. Zomato was only a food delivery company, not grocery delivery company. They could have started their own. Anyway, they had app, they had network, they had everything. But instead of they trying to do it by themselves, they found out there is another company. Let's just buy. Diversification, the third reason. What else? To reach a different geographical location, different type of market, different age group. You may be selling a product, but maybe you're restricted to some geographical segment. In India, some banks are like this. If you say in Bangalore, Bandhan Bank, people will hardly understand what I'm saying. They might have seen one branch, two branches, maybe one or two random place ATM. But in some other part of the country, Bandhan Bank is a very big bank. Okay, like how we have some banks which are popular here but not so popular. If you say Karnataka Bank in Orissa, people will give you the same look. Understanding what I'm saying? So when you want to expand, but then expansion is not by launching a new product, but to reach out different geographical location. Otherwise, this bank only has to go and open branches in every place. Instead, if you find a localized, available, popular, famous bank, there is another bank called Jana Small Finance Bank, JANA. You might have seen again very rarely here in UP, Bihar, Bengal, Jharkhand, and that location, that geographical location. This is another popular bank, and I have checked with Ashim Jana sir that Jana, this Jana has no relationship. Okay, so no insider trading scope, not going to happen. Spelling is same, but they're not relatives. Okay. Now again, Jana small finance bank is not popular here, but it is popular in the Orissa, that part, Jharkhand, West Bengal part of it. So when you want to expand beyond your target market, the better thing is of you going there, convincing people, and starting everything by yourself. You acquire someone who is locally famous, right? Now, what was the reason for WhatsApp acquisition? The four reasons that you told me. Why did Facebook acquire WhatsApp? Because they realized people spend more time on WhatsApp than on Facebook. Instagram was not Facebook company, by the way. Instagram was a separate company altogether. YouTube was not part of Google. It was a separate company altogether. By the way, Instagram was invented for something else, but today we are using it for something else altogether. Uh, some of you may know there is a company called, not company, app called Pinterest. Those are into some artwork, they will know this. Correct? Instagram was originally, when they started, was exclusively for photographers to upload the nice photos clicked by them and share it among other photographers. So it was more like how Pinterest is for artwork and other things today. Instagram was mainly for photographers, digital uh, artwork creators. That was a restricted target, but then it's no more that way. YouTube was a pure video based app. People never used to go on YouTube and search something. Understanding what I'm saying? YouTube was acquired by Google long ago. Before Instagram, Facebook came, there was another company called Orkut. ORKUT. Heard of? This was the first in India famous social media before all of this came. Facebook came much later. Orkut was the first one, and Orkut was also a different company. Google acquired it, and YouTube was a different company. Google acquired it. Here now, WhatsApp was a different company. Facebook acquired it. Instagram, same story. Therefore, the acquisition can be for many reasons. One primary thing in numbers, if you have to understand, post merger, the value of the newly created entity should be more than the value of the two independent entities, and that's what you call as synergy gain, right? If there is A Limited, Zomato, there is B Limited, Blinkit. Now you do the valuation of these two companies independently, 700 lakh, 200 lakh. But when you merge, it is expected that the value of the merged entity is not 900 lakh, it is 900 plus some gain, and that gain is called synergy gain. But in classroom, there are problems where they specifically mention there is no synergy gain in this deal. That means after buying, sum of the two parts will be the value of the new company. If there is no synergy gain, then why did you buy another company? Then to kill the competition. Understand, it's not always for synergy gain. I am running a company, she is running a company, I'm planning to acquire, because after merger, I am thinking, I'm just putting some numbers. A Limited, B Limited, value of AB Limited is supposed to be more than the total of A plus B. If that happens, it's called synergy gain. But in classroom, there are questions where in question specifically they mention that there is no synergy gain expected in this deal. If there is no gain, no synergy gain, then why are you acquiring? You're acquiring only because you wanted to kill the competition. I was doing 700 PAT, she was doing 200 PAT, profit after tax. Post merger, together company is doing just 900 PAT, nothing extra. That means my target, my purpose of acquisition was not to make extra money out of this acquisition, was just to ensure that there are no competitors. Adani Group is currently doing exactly same thing in entire cement sector. Those who have interest, read about it. They are buying every cement company. Now what happens when you start accumulating cement companies? Then all the construction companies will also be dependent on you. First, you will gain monopoly in cement sector. Second, real estate construction companies like Brigade, all of this, Prestige, these companies will also be dependent on you. Imagine, just an example, these are not correct numbers. There are 10 cement companies. In that one group is holding 7 of them. Other three are independent, three different companies. What happens when you hold 70% of the market share? One, you become dominant player within cement sector. You can export cement and others. Second, real estate companies like Prestige, Brigade, and all of this who will construct buildings, they will be dependent on you for cement, and then you can do joint ventures with them because 70% of the market, if not this company, that company, but any company is ultimately like your Oppo and Vivo. Finally, it is going to the same legal entity. It looks like two different products, look like there is a tight competition, look like this store versus this store, but ultimately it's all going to the same organization. Right now, if you want to understand what is the meaning of killing competition, creating monopoly, cement sector, Adani Group is the best example. This has been happening, not that they acquired everything once. Last 1.5 years, continuously, every 3-4 months, you will see this development happening. Maybe they will acquire few more. Once they cross 50-60% within cement sector, then this game will change. Then cement prices may go up, and because there is very less competition, then you and me also will have no choice. Just like Jio and Airtel now, the day you come to these only two players, even if they increase the charges, one guy will increase, the other will easily increase because they know people can't go anywhere other than these two. You notice now, whenever Jio increases, Airtel increases, they don't care. They're not worried whether people will feel. If they feel bad, they have to go to Jio only. Airtel will not think whether my customer is feeling bad. If they feel bad, Jio has already increased. So let me also increase. Follow this. Anytime either Jio increases or Airtel increases the tariff, the call charges, data charges, immediately next day the other company will also increase, because now we are in a duopoly kind of market. Hardly anyone is using other SIM cards. This may happen in cement sector also. Then what happens if cement prices go up? Not only cement price will go up, entire construction cost will go up, real estate prices will go up, your buildings, commercial property, houses, everything will become very, very costly. And we are on the way, according to me, in that direction. 3-4 years from now, if Adani acquires all these companies, ACC, Ambuja, they're doing one after the other. If they acquire all of this, not 100%, even if they cross 50-60% of cement sector, then they would have killed the competition. Then the prices can shoot up and we will be left with no options. Make a note. After merger, it will be called merged entity or merged firm. Merged entity or merged firm. Last bullet point, I don't think you need to copy. Very simple sentence to understand. Merged entity may be called as A, or they may come up with some other name. They may even call themselves as AB Limited. Understanding? I don't think that needs to be copied. Now, what is the benefit of merger and how do we calculate? From here, the practical segment begins. Listen, benefit of merger is equal to, observe this, PV is present value basically. So value of AB Limited minus value of A plus value of B independently. Value of AB will come post merger. Value of A and value of B will be done before merger. So pre-merger, my company A Limited was valued at 700 crore. B Limited was valued at 200 crore. Now together we are valued at 950 crore. That extra 50 that you created is benefit of the merger. Yes, but this benefit will be enjoyed by both the shareholders of A and the shareholders of B, provided we give shares to the shareholders of B Limited. If you remember, in intermediate, in amalgamation, there were two varieties, not merger and purchase nature. Either we can give cash to the shareholders of the vendor company, or we can issue them shares. Remember this, purchase consideration discharged by way of payment of cash or by way of issue of shares. Taking Zomato example, Zomato can either give cash to the shareholders of Blinkit, or for every one share held in Blinkit, you decide a share exchange ratio and allot them that many shares in Zomato. Now think and tell me practically, forget what was there in Inter. Will shareholders of Blinkit agree if you come with a cash offer? Out of the two, which one is more attractive, lucrative? Which one they will fight for? Blinkit shareholders will ask for shares of Zomato. They will not take cash and go, because once you take cash, then you are letting your controlling interest and power go. After that, if company starts growing like crazy and you have cash with you, and then you feel bad, why did I take cash that day? I should have stayed back as the shareholder, and I should have taken the share of the new company, that is Zomato. By the way, after acquisition, Zomato did not change their name. Blinkit became one part of Zomato. That was there in the last slide. The name can continue as A, or they may come with some new name. They did not come with new name. They continued with Zomato as it is. Very rare questions, even in class material, you will see where the shareholders of the vendor company accepted cash. In reality, also, they will not accept cash because that cash will be paid based on that day's valuation. After that, company can grow many times. It can grow 5 times, can grow 10 times. And if I'm a Zomato shareholder today, instead of taking cash, that will be a good business to stay as a shareholder for long term. Because, in my opinion, again, disclaimer message, don't buy share based on this. For learning purpose, Zomato, Swiggy, or Zepto, the type of business they are into, if you analyze their industry, not individual company, I have no doubts whether this business will continue to rise in future or not. I believe traffic will only be more, lazy people number will increase, people who cannot control cravings will only add, and available money in the pockets of individuals like you and me will only increase, and urbanization will only continue to happen more and more. If all five is going to happen, then these kind of businesses will definitely shine. If more people have more money in the pocket, they will be okay to spend. Nowadays they even have this, you pay some 99 rupee 1 year free delivery, some 3 months 30 rupee, 10 deliveries free. The people don't think too much before paying 30 rupee. Correct? I think 30 rupee 3 months, some I forgot the name, some premium. Gold, correct. You can get that. Now people are spending all of this, spending money on all of this, and during Diwali, by the way, they increased their platform handling fee. Instead of 5 rupee, I think they made it 10, or from 10 they made it 20. And you should have seen yesterday there was a CNBC report. This Diwali, compared to all Diwalis in the past, these online platforms, the 10-minute delivery apps, made highest ever sales. I forgot the exact number. Actual number is some lakh crores in those 4 days across country. Food and groceries, gift, everything all together on that platform. And they charged higher rate during that peak 3 days. But then also people did not order less because it is extra charges. They paid extra charges and they ordered. So if this is how people are thinking, and more urbanization, people shifting from smaller towns to bigger towns, and more lazy people who will not get down from fourth floor to ground floor and cross the road and have food and order, uh, wait for January. Swiggy and Zomato, both, they will release one report. They won't reveal the name, but they will reveal some funny data. Highest number of orders done by whom, which was the shortest distance order, longest distance order, highest order value in a single order, and who gave them maximum business. They won't mention the name, but they will mention a person from Bangalore ordered from a hotel which is 0.3 kilometers away. 0.3 kilometers is 300 meters. Upar Darshini, exact answer. Upar Darshini ordered, and that details they provide once the calendar year is over. Highest number of orders last year. Report I was going through, someone has ordered on Blinkit and Zomato 980 times in 1 year, which is average about 3 times every day. And that guy is from Delhi. That's all they say. They won't tell the name. And this was there in the snapshot of top 10 funny things that happened with the company. Now 3 times a day if you're ordering, that means you are paying so much of delivery charges over and above the price of the product. And I think he became a friend with the delivery boy if he's coming to your house thrice again and again. Sorry? So this, if this trend continues, I know such nut cases are not there everywhere, but then more people are ordering. You think your own spending on these platforms 2 years ago and today, and willingness to spend towards all of this is only going up. And growing urbanization, more lazy people, more cravings and can't control cravings, such people, and more apps like this, I don't think this business is going to go down at least next 15-20 years, unless the urbanization starts reversing, which I don't see happening in India. I don't have any doubts in these kind of business. Now if you are a Blinkit shareholder, if I pay cash and then you're gone forever, correct, and then if you want to buy share, then you have to buy from the market again independently. Therefore you will never accept in these kind of industries cash offer. You will always go for shares to shares offer. That's why 99% of the questions in class material and in real world is cash exchange, sorry, share exchange, and not cash paid ratio. Yeah. Benefit of merger is, please make a note, value of merged firm minus value of A before merger, value of B before merger. That means you have to do valuation thrice. Zomato separately, Blinkit separately, pre-merger, and post-merger redo the valuation. Then you'll get to know the benefit. Is some basic type examples before we start question 1 from the book. Start making a note. If you want, you can write it in short forms as per your convenience. I have no problem, but we have to copy this examples without that difficult to do the sums. You can use your own short forms, totally okay. Firm X wants to acquire Y. The respective values are 50 and 30. When they say respective values of these two, this is obviously before merger. Yeah. It is expected that the value of the merged entity will be 96 lakh. This is the valuation done after the merger. Benefit of the merger is dash 96 lakh is a post merger valuation. 50 and 30 were the values independently. That means benefit of the merger is 96, correct, minus inside the bracket 50 plus 30. 96 minus this is 16 lakh rupee. Now you need to know this 16 lakh benefit will not be enjoyed only by shareholders of X. It will be enjoyed even by shareholders of Y if you issue them shares. Remember, I told you 99% of cases shareholders of Y will not take cash. They will ask for shares. After merger, they will also get the benefit of this 16 lakh. Okay. By the way, since I'm taking this Zomato and Blinkit name repeatedly, just for your reference, I'll show a small slide. The valuation of Blinkit, I want you to know the numbers. Yeah, I know this is part of previous topic and that theory is still pending. We will discuss, no worries, but as a reference point, let's go through this. Blinkit was acquired by Zomato in 2022 for a valuation of 4,447 crore. Now this is the value of Blinkit before the merger. Same way Zomato would have done their own valuation without counting Blinkit. Suppose that number is 6,000. Now merged entity will not be 6,000 plus 4,447. It will be little more than that. The difference between PVAB minus PVA plus PVB is called the benefit of merger. This value was almost 40% less than what Blinkit estimated few months before merger. This is where the negotiation part comes into play. 4,447 was not the value that valuation report gave. They gave much higher value. But then Zomato directors did not agree to buy Blinkit at that rate. They said, we have also done our own valuation of you, and we don't believe that your number is worth 7,000, 8,000 crore. We are going to buy your company if you are ready 4447. Beyond that, we are not going to buy your company. Now, how this negotiation happens, we will study in the ongoing merger and acquisition chapter. Because think, Blinkit wants to show overvaluation, but if Zomato agrees to that number, then they have to issue either that much of shares, or if it is cash, then you have to pay so much of cash. Therefore, these guys will take a conservative valuation, the Zomato people. But Blinkit will definitely take an aggressive valuation, because higher value you show, higher bargaining power you get when you sit for meeting with the Zomato's director. Sources of revenue, these things you know: commission from those stores, delivery charge, net of amount paid to the delivery boy, and the advertisement. And by the way, those who do not know, I have one client, don't ask me the name. They are into millet products. Okay, all this millet upma, millet this, millet that. They have tied up with these Instamart and all of this. Sad story is, according to them, and based on the data of that company that I have seen, they sell at a slightly higher price if it is on these platforms, and sell at a slightly lower price if it is offline. That means if the same item is offline, DMart store is available at 100, on Blinkit it will show 110. Okay, but that doesn't mean this company is making extra money. They have to pay a big amount of commission to these Swiggy, Zomato, and whoever is the delivery agent. And then for the customer, that is you and me, number one, it is costly by 10 rupee. Number two, on top of that, we pay the delivery charges, and the delivery charges will go to delivery boy. And those delivery boys are also not happy, because they feel or they think they're earning less. Now the seller is not happy because 110 minus all this cut, he may not be getting super margin. Customer is not happy because he's paying 110 10 extra, on top of that some delivery charge. Delivery guy is not happy because he thinks I'm delivering, I'm just getting 30-40 rupee per delivery. And Blinkit books or Zomato books are showing slight profits and not great profits. So most of these hotel owners or these food product sellers, if you have clients, talk to them. They're actually not great. They don't show great happiness with tying up with these companies, including my client who is into this. And it's a big company, not a small company. And every month, at least 2 times, I meet them. I'm more of a retainer consultant to them. Every month I meet, every time I discuss offline sale, online sale, what's the movement happening. And every time I'm hearing only the same answer, whether it is ice cream sale, hotels selling food products, or these groceries, any type of item, durable, non-durable. They were unhappy with Amazon and Flipkart earlier, but now they've started liking Amazon, Flipkart after Swiggy and Zomato. They think their commission was also less, and so on. I do not know the next sentence that I'm saying. I have not done validation of this. What I heard is, if you buy some items from some hotels directly from the hotel website versus buying it through Swiggy or Zomato, many people on social media say they get less quantity. I do not know. I have not validated this. I do not want hotels to come back to me on this sentence. Basically, what I'm saying, if I order, say, biryani, once it comes to my house, I don't weigh it and eat. Obviously, no one is doing that, according to me at least. I buy, I eat. What many people are saying, I've seen some posts on social media also. One guy literally weighed it. Okay. Same day, same time, he goes to the hotel website and orders, and same item he orders on these platforms. The quantity that he's getting through the Swiggy or Zomato is slightly lesser than the quantity he is getting when he orders directly from the hotel. I can understand part reason is, when hotel using their own website, they make sale, they don't have to pay any commission to anybody. No advertisement, no need to pay. But then when it is through Swiggy, they have to pay. Delivery cost is anyway there. But then this commission portion, maybe that they want to recover somehow. The only way you can recover, either you give a bad quality item which they don't want to do, or give less quantity. Just like how the number of biscuits in Little Hearts is reducing year after year after year. Either you have to reduce the price, or you have to give less viscous. Otherwise, how will you make margin? Or you have to reduce the size. First of all, it is little. I don't know to what extent they can go. Those who are eating Little Hearts from many years will understand what I'm saying. The quantity is only reducing. Coke used to be 250 ml, and we know the rate. And now, if they make the rate on a higher side, people will get to know. So they decided to make from 250 ml, they made it 225 ml, kept the same rate. Net, they have made it costly. But you and me will not understand because the bottle is same. The filling part is less. And who is checking 250, 220, 230 when they're buying? They know the rate in their mind. 30 rupee, I get that small bottle. 30, 30. 30 is set. 250, 225 is not set. So somewhere they have to. Maybe my doubt why those guys believe you get less quantities because they have to pay commission. And they can't do two separate biryanis, one for Swiggy people and one for offline people. So they cook together. So the only way they can escape the loss of this commission is by giving slightly lesser quantity. Last 2 minutes, what I told you, I have not validated. I do not know whether this is true or not. What I know is what I told you before that. Many of these food companies are not happy today with Swiggy and this, and they want more players to come into this game because now the sellers, the hotels, this millet company, they have no bargaining power. Because if you say, I won't be on Zepto, you will lose business. Imagine someone today saying, I won't be on Zepto, I won't be on Blinkit, I won't be on Instamart and Big Basket also. I'll do only offline sale. Then your visibility will be very less. Only those who come to offline will buy. And that number in bigger cities is going down. Therefore, you do not have bargaining power because you just have these 2-3 players. So Blinkit makes good money from the net of delivery charge and ads. And by the way, what is this ads? Those who do not know, when you open any of these food apps, some hotel recommendations will come to you. You might have never searched, but it comes to you. For that, they have to pay to be available on top 5, top 10. See, if I just type masala dosa, there are hundreds of hotels which can sell masala dosa. Who will decide which name should come first? That depends on who pays more to them. The visibility, to get that visibility to come in top 3 searches, 5 searches, they have to pay, just like how Google collects money for search engine optimization. So they make good money. Read fourth bullet point, presence of Blinkit as on the date of valuation, not today. This is 22. 15 major cities, no major assets were held by Blinkit because this is again digital platform. You do not need, that means you cannot go by the asset based valuation. Zomato and Blinkit merger was an all equity merger. What is all equity merger? No cash paid. All the shareholders of Blinkit were allotted shares in Zomato. The CEO, CFO and the top management of Blinkit, they have lock-in period. Understanding what I'm saying? You have to continue with us. You should stay with us as our shareholders because Blinkit, those promoters, directors, even they had good number of shares, not just the general public. So they have 3 years lock-in period, and that 3-year lock-in period will get over in 2025. And whenever this happens, there is a price sensitivity attached to it. What happens after lock-in period is lifted? They are free to sell. And these guys hold like 6%, 5% stock. And if they decide to sell once for all, suddenly huge sale will happen and then the prices will collapse. And this will happen in 2025. So now this 4447 is what we need for our topic. Blinkit was acquired by Zomato at a valuation. This valuation is Blinkit's valuation. That means it is value before merger. Now please answer. By paying 4,447 crore, if you are a shareholder of Zomato, what is your benefit? I repeat my question. You are a shareholder of Zomato. Your company decided to pay 4,440 crore, let's say 4,000 crore, and acquired Blinkit. What's the benefit to you? One, there is cash outflow, but you're not paying cash. You are allotting shares. Tell me what will happen in the next AGM. Number of shares will go up. That means there is all likely possibility your EPS will come down because now the denominator number of shares are going up, but also numerator will go up because EBIT earlier was only Zomato EBIT. Now it is Zomato plus Blinkit EBIT. That means earning available to equity shareholder will also increase, but you may not earn same EPS next year. If you are earning 15, it may become 16, it may become 14. Market price of Zomato before acquisition, after acquisition may change. Therefore, whenever there is an acquisition, shareholder of A, shareholder of B, both their wealth will get impacted. If it is a good merger on a positive side, if it's a bad merger, then on a negative side. So we have to learn all the things from both angles, from the viewpoint of shareholders of A, from the viewpoint of shareholders of B. Next. Heading: cost of merger to purchasing firm. Now in my example, purchasing firm is A, correct? In the two possibilities, one second, I'll show the full slide. You can actually make two arrow marks and then copy. Mid of the page you write cost of merger to purchasing firm. Under that, two arrow marks. If consideration is discharged by paying cash, one side. What is the other possibility? Consideration is discharged by issue of shares. Yes. Under first arrow mark, cost of merger to A will be cash paid to A. Sorry, cash paid to B. Paid by A means paid to B. Cash paid minus value of B. We have examples on all of this. Not to worry, we'll learn with numbers. I'm buying a company called B whose value is 40 lakh, but I'm paying 41 lakh. Then 41 minus 40, that 1 lakh is my cost. I am A, I am buying B, paying more cash. Yeah. What you studied in Inter is how to record that 1 lakh extra. Remember, goodwill, capital reserve, net asset taken over is more than consideration paid. But if you issue shares, then value of the shares issued by A. Issued by A means issued to B. Correct? Issued by Zomato minus value of Blinkit. One by one. With example, we will understand. Listen. First, write the heading and then we'll discuss the numbers. Understanding of cost to purchasing firm. For our example purpose, it's A Limited. In case of issue of shares, that is, if A Limited is issuing shares to B Limited, then how to calculate the cost. Listen, in that Blinkit slide that I discussed, what was the valuation? What was the value of Blinkit? 4447. Zomato might have paid 4500. Valuation was 4447, paid 4500. The difference is called cost to Zomato. The excess money that you have paid is called cost to Zomato. But they did not pay cash. They issued shares. And that's what we are discussing now. Read the heading. Understanding of cost to Zomato in case of issue of shares to the shareholders of Blinkit. Let's take a small example. Value of A before merger. Remember, A is the purchasing company. Value of B before merger is 60 lakh. A is acquiring B and value of A after merger is 250 lakhs. This is value of A, B. Now you see this 100 lakh was independent value plus 60 lakh was independent value. 160 will be the total of independent values, but the merged entity value is 250. In calci, 250 minus, sorry, 90. This 90 is called the synergy gain. We will write the note on synergy later, not now. The difference basically. Yeah. Number of shares of A before merger is 90. Number of shares of A after merger 90 plus 30, 120. These are all example numbers. Yeah. Now tell me, why is it 90 plus 30? Who are these 30? The shares that you issued to the shareholders of B Limited. Understanding? You will not issue shares to your own shareholders when you do an acquisition. The new guys who have come on board, to them you have to issue shares, and you have issued 30 shares to them. Now, how to calculate the value of 30 shares after the merger, and that's what we are trying to learn. Observe the numbers. Value of 30 shares is equal to, in calci you please do, 250 lakh is the value of the merged entity, correct? And that should be divided by total 120 shares. Now this will give you value of one share after merger, correct? And you have issued 30 shares to those people, the people from Blinkit. That means you gave them 62.5 lakh worth shares. 62.5 lakh rupees worth shares. But how much was the value of that company before merger? Only 60. The difference, 62.5. This can be done in one more style, but I'm just going to the next slide. The difference between these two, 62.5 minus the 60, the 2.5 is the excess money that you pay. In accounting, you call it goodwill. We are paying extra. Remember, if you pay less, you call it capital reserve. Used to pass a journal entry. All asset taken over, liabilities taken over. The difference is recorded either as goodwill or as capital reserve. Yes. Now tell me, the 62.5 can be calculated in one more style. 250 lakh is the total value. In that, 30 out of 120 belongs to them. 250 lakh is the total value. Out of that, 30 by 120 belongs to them. Them means B Limited. We are A Limited. They are B Limited. Now this can be written in a formula style. Value of AB into number of shares to be issued by A to B divided by total number of shares of the merged entity. This in study material they write in the formula style. Value of a share is equal to PVAB into alpha. Now what is this alpha? Read. Alpha represents degree of holding of vendor firm in merged firm. Explain what is this? Degree of holding of Blinkit shareholders in the merged entity. That can be written as 30 by 120 because total shares will be 120. In that, 30 belongs to the shareholders of Blinkit. That means 30 by 1. Don't call it minority interest, etc. Don't confuse yourself. They are part of our company now. 30 by 120 belongs to them. 90 by 120 belongs to our old shareholders. So 30 by 120 can be called as degree of holding. And that is written with a sign alpha. And in study material, they use this formula. Value of share is equal to value of the overall company after merger into alpha. Copy as it is. Actually, we can stop here itself. This is much easy to understand. 62.5 in this style. But then in study material, they have shown this into alpha. So better to be aware of this style of presentation. If you pay cash, then you don't have to do all this working. that 62.5 will be given in the question as 62.5 lakh cash is paid. Then directly that minus this, easy to work out. But if you issue shares, then you have to calculate in a detailed way. And this formula, you circle it, mark it important. Value of share is equal to PV is present value, basically value of AB. AB is a merged entity. Value of AB into alpha. Alpha represents degree of holding of Blinkit shareholders divided by total of shares of Zomato post merger. Copy it. Can we? Example 2. Firm X wants to acquire firm Y. First understand, I told you can change these wordings and copy it later. Their respective values are 50 and 30. That means value before merger, independent value. Firm X has to pay 35 lakh to firm Y in this regard. When they say you have to pay, that means this is merger by way of cash settlement. Very rare practically, but since we're starting the discussion, we should know. Find out the cost of the merger to firm X. How to find out cost of merger to X is, here you are paying the cash paid by X, or you can understand it as cash paid to Y, paid by me to him. You can say in two different ways, minus the value of Y. This will be simply 35 lakh is paid minus 30 lakh is the value. This 5 lakh rupee is the cost to you. Simple. I told you you can copy it in a rough style, no problem. In accounting style, you recognize this as your goodwill because you are paying more than the net asset taken over. Whenever you pay cash, sum is very easy because only two things you have to compare. Just write in bracket class note. In reality, in reality, acquisition with cash deals, acquisition with cash deals are very less. In bracket, that is most of the M&A, that is most of the merger and acquisition, M and A, will happen on share exchange basis. Close the bracket. So cash is very less. Maybe you'll have one or two sums, because that's not the reality. All of them want shares only. Yes. Good question is this. All of you, take time, go slow. Read. Firm X wants to acquire firm Y. Their respective values are 50 and 30. Total number of shares of X is 5,000 and number of shares of Y is 6,000. It is expected that the value of the merged firm will be 90 lakh rupee. Exchange ratio is 2 is to 3. If you remember in mutual fund topic, we had bonus ratio. Now 2 is to 3. Find out the cost of the merger to X. Now cost of the merger to X in this case, since you are not paying cash, you have to find out value of the shares allotted to the shareholders of Y. How many shares are they sitting with? 6,000. And what is the exchange ratio? 2 shares for every 3 held. With cross multiplication, we'll get to know how many shares we need to issue. Listen, calculations we can do later. When we issue shares to them, we won't issue shares to ourselves. After merger, Zomato will not issue shares to the shareholders of Zomato again. They'll issue shares only to the Blinkit shareholders. That means number of shares after merger will increase. That increase is only because of these new people, not because of the old people. So what you have to do, remember the alpha, number of shares of those, the Blinkit shareholders divided by the total number of shares into value of merged entity, that will tell you. And from there, if you take out how much was independent valuation of Y, it was worth only 30 lakh. Previous sum, it was given directly. So cash paid minus this we could do. But now it's not cash paid. We have to do little extra calculation. And this is what happens in most of the real cases. Cash is not the reality, more of academic in nature. Start first. Write the example data first. You can use short forms, no problem. These are all just examples for learning purpose. X is acquiring Y. Value of X 50 lakh, value of Y 30 lakh. Number of shares in X, number of shares in Y. All of this is pre-merger. Value of the merged entity. You can even write it as value of XY. XY is a merged entity, is 90 lakh. Exchange ratio 2 is to 3. By the way, once you start the sums from the book, exchange ratio won't be printed. We have to decide that. Yeah, 2 is to 3. Find out the cost. Solution. First, understand properly what is the meaning of 2 is to 3. For every 3 shares held by them, we are issuing 2 shares in our company. Correct? 2 shares for every 3 held. That means if you are a shareholder of Blinkit holding 3 shares, you will get 2 shares of Zomato. That means if you are holding total how many shares Y Limited has? 6,000. That means 6,000 into 2 by 3 or cross multiplication 2 for every 3 for 6,000. How many shares? That number is I think 4,000. That means they will now be holding 4,000 shares in the merged entity. And you have your own old shareholders who are holding 5,000. That means new number of shares will be 5,000 plus 4,000. That will be 9,000. Able to follow? You have your own 5,000 shares that won't change. New people, 6,000 of them are coming, but we're not giving them 6,000 shares. We are giving them 2 for every 3 held. So when I cross multiply, I got to know I'm giving them only 4,000 shares of my company. That means total shares after merger will be my own 5,000 plus newly issued 4,000. Total 9,000. All this we have to first show in the working. Start. Exchange ratio 2 is to 3. Meaning for every 3 shares of Y, Y is a vendor company or seller company. X company will issue 2 shares. Therefore, number of shares to be issued will be 6,000 into 2 by 3. Correct? 4,000. After this, one silly mistake many students do. Total number of shares of the merged entity. You should not apply this 2:3 or 5,000 also. 5,000 is your own shareholder. 5,000 will not change. The new people who are coming, 6,000 are coming, but we are not giving them 6,000 shares. We are giving them only 4,000 shares. For Zomato shareholders, why will Zomato do 2:3? It is only to the Blinkit shareholder that this 2:3 should be applied. So total shares after merger will be 9,000. Now to calculate cost of merger. Now this is, remember, either you can use that alpha or without that formula also you can do. How much is the valuation of the merged entity? 90 lakh. 90 lakh into 4,000 by 9,000 will belong to Blinkit shareholders. 90 lakh is the post merger valuation. In that 4 by 9 belong to them. Correct? Remember this 4 by 9 in the previous slide was called alpha. How much is that number? No, not final number. 90 lakh into 4 by 9. 40 lakh. But how much was the cost? Sorry, how much was the value of this company? Only 30. That means we are giving them additional benefit worth 10 lakh. If it was cash paid, then directly I would do the last line. Cash paid minus 30 lakh. Since I'm not paying cash, I have to calculate the value of the shares. Value of the shares post merger only, because I'll give them shares of the merged entity. Done. Give a try. What if exchange ratio is 1:1? Tell me what would have happened. 1:1, then we would issue how many shares? 6,000. Then total number of shares will be 5 plus 6. Remember, 5 won't change. Never change Zomato shareholders share pattern. The Blinkit will be 5 plus 6, 11. Then what happens now? 90 lakh into 6 by 11. How much is that? 49.09 minus their valuation was only 30 lakh. Answer comes to 19.1. Because remember, 1:1 is 1 by 1. 1 by 1 is equal to 1. Hope there is no doubt in this. But when you say 2:3, 2 by 3 is not 1. You're giving less shares, 0.66. Understand why 10 lakh became 19 lakh? Because you're giving them more shares. Earlier in 2:3 ratio, we were giving them 6,000. Now in 1:1, you're giving them 6,000 shares. That means you're making them more powerful. Correct? That means Zomato shareholders will not be happy to give so many shares. You know the biggest problem with most of these deals? Everything will happen. All the meetings. Finally, when they come to share exchange ratio, is when most of these deals will stop their discussion and shake hands and say, thank you, you remain separate company, I'll remain separate company. Because think, if you're a Zomato shareholder, you want to issue as less shares as possible. And if you're a Blinkit shareholder, you want to get as many shares as possible. That means Blinkit shareholders want maximum exchange, whereas Zomato shareholders want minimum exchange. They don't want to give more shares because they don't want others to become their company owners. This you know from intermediate. Shareholders don't want new shareholders to come. Then EPS will come down, power will get shared. Equity shareholders do not like other equity shareholders. Less the equity, high the EPS. Basic, this we all know. That means Zomato will bargain very hard to keep exchange ratio as low as possible. Blinkit will bargain very hard to keep the exchange ratio as high as possible. And they will come with two numbers. Both will think in favor of themselves, correct? And then the negotiation will happen. And that's when things get dragged. They say I'll issue 2:3, they say 1:1. Now 2:3 is 4,000 shares, 1:1 is 6,000 shares. After months together discussion, they may come to some 5,000, depending upon who bargains hard. You will then decide whether it will be 1:1 or 2:3 or somewhere in between. Most of the mergers go till this, and at share exchange point, they get stuck. because nobody wants their own shareholders to be unhappy post merger. Understand? Zomato director is worried, Zomato shareholders will be angry. Blinkit director is worried, his shareholders will be unhappy. You can't keep both of them happy unless there is such a big synergy gain. If there is a huge synergy gain, then both will be happy, but that may not happen in every case. But keeping both happy in any deal is impossible. When you bargain for anything, say go to Jayanagar shop and you bargain for a dress, finally you come to one number, both can't be happy. One of them has to be sad in any deal. How can both be happy in a deal? If you are happy, that means you do not know full data. Understand? You say, suppose seller says 1000 rupee, you bargain from 600, bargain for half an hour, finally 800, you close the deal. You are happy because you brought it down. He is happy he brought it up. But then finally seller has to make profit. He is not selling at any loss. That means he is actually happy. You are not happy. But you are happy because 1000 came down to 800. Maybe the cost of the dress is only 450. That data you don't know. Therefore, only he knows. Therefore, in reality, both in any deal will not be happy unless there is such a big synergy gain. And you don't get huge synergy gain. You will see some questions. Synergy gain is 5%. That means post merger valuation will be higher by only 5% compared to the total of independent valuation. You won't get 30-40% synergy gain. 5 lakh plus 5 lakh together can become 10.5, cannot become 13, 14, 15. Practically that's not possible. Now, what we discussed so far is one side, cost of merger to Zomato from their angle. Now on the other side, benefit of the merger to the vendor firm. Now think for a minute, you are a shareholder of Blinkit. Tell me, when will you be benefited? If you are a shareholder of Blinkit, how to calculate benefit to you? In simple terms, benefit to you should be cost to the other company. Benefit to B means cost to A. Benefit to Blinkit shareholder is cost to the Zomato shareholder. At base level, that is the understanding. Start with first heading, benefit of merger to vendor firm. At base level, this is a simple sentence. Benefit of merger to vendor is equal to cost of the merger to purchasing firm. Profit to you is loss to somebody. Benefit of merger to purchasing firm. That means how to calculate the benefit to Zomato. This depends on the data given in the question. And for that, once we start question number 1, you will understand. Make a note. Determination of benefit depends on information given in the problem. Under that, there can be two possibilities. Let's understand first before copying. In case total benefit of the merger and benefit to vendor is available, then the balance benefit to you, read properly. If we know total benefit of the deal, and in that you know how much is the benefit to the vendor firm, then balance should be the benefit to the purchasing firm. If we know total benefit is 85, in that 15 belongs to one person, balance 70 belongs to another person, only if it is easily determinable. But in some cases it will not be easily determinable. Copy this. In case total benefit of merger and benefit to vendor firm is determinable, this depends on question, what type of data they give. In case total benefit of merger and benefit to vendor is determinable. Now, what is this total benefit of the merger? The synergy gain that I told you. In that, if you know how much is for the one party, the other party, then you know balance is for second party. Simple. Benefit of merger to purchasing is equal to total benefit minus benefit to vendor. When you're writing, you can keep replacing this purchasing firm, vendor firm with Zomato and Blinkit and follow the story. Becomes easy. What is the meaning? Benefit of the merger to Zomato. That's what you're writing now. Benefit of merger to Zomato is equal to total benefit minus benefit to Blinkit shareholders. If you find out total benefit, in that you know how much is for them, the balance is for you. Only two parties are there anyway. But this, if it is easily determinable. But there are some cases, just a minute, I'll finish this. If it is not determinable, then you have to do a bit of calculation. First copy, and then I'll discuss one example. Benefit of merger to Zomato is equal to, this is slightly detailed writing, go slow. Wealth of shareholders of Zomato after merger minus wealth of shareholders of Zomato before merger. Now, wealth is measured using MPS, market price of the share, into number of shares that you are holding. This you will not get the comfort unless we do a sum. Don't worry. Can any of you try with a simple example and explain these last two lines to me? Wealth of shareholder of Zomato after merger minus wealth of shareholders before merger. Assume you are a shareholder of Zomato. You are holding 10 shares. Post merger, observe the wordings, don't copy now. You are a shareholder of Zomato. You are holding 10 shares. Post merger, its market price is 220 rupee. Now this is your wealth post merger, and you are holding Zomato share before merger. That time its value pre merger, I can write 10 shares were worth only 180 rupee. That means your wealth was 1800 and now your wealth is 2200. That means your wealth has gone up by 400 rupee. Like you, there are 10,000 shares. This will be considered as the benefit to the shareholders of Zomato. That's what is there in your text. Read now. You'll understand what you have written. Wealth of the shareholders of purchasing company after merger minus wealth of the shareholders of the company before merger. Now to measure wealth, you won't take EPS, you will take MPS. My wealth is not EPS of the company. My wealth is the MPS of the shares of the company. I was holding 10. It was 180. Now I'm holding same 10. By the way, will my 10 go up? You have to follow this, otherwise you will miss out. I was holding 10 shares of Zomato. Post merger, will 10 become 12, 13, 14, 15? No, I won't get extra shares. Those Blinkit people will get extra shares. I told you never add share exchange ratio to the shareholders of. So why will Zomato issue shares to Zomato shareholders again? They'll issue shares to the Blinkit. We are not doing bonus or split here. New people are coming. For them, we have to give some shares. I was holding 10 before. It was worth 10 into 180. Now also I'm holding 10 only. But because of Blinkit merger, share price has gone up to 220. That means my wealth has gone up from 180 to 220 for one share. 40 rupee. Like this, if you multiply by total number of shares, that will be the total benefit to all of us. Able to follow? On this, there are examples. We'll take it after a break. Small example, this is question and answer actually. Benefit of merger is 16 lakh. Understand, when they use the word benefit of merger, this is total benefit. In this, if we know benefit to the vendor, then the balance is the benefit to the purchaser. This is a case where it is easily ascertainable. Remember, there are two possibilities. If it is ascertainable, determinable. If it is not determinable, then we have to do some calculation. This you copy, this is example. Question also, answer also, both. Now see example 5. This is copied. This is easy to find out. Total 16 lakh. In that 4 lakh belongs to one set of people. Balance has to be other set of people. But look at this question number, example number 5. Value of purchasing company. Zomato was 100 lakh. Value of merged entity 150 lakh. This is Zomato post merger. Number of shares of purchasing company, that is Zomato shares were 10 lakh. Number of shares of merged entity 12 lakh. Now tell me, you were only 10 lakh and post merger it has become 12. That means you issued 2 lakh shares to the Blinkit shareholders. Find out benefit to the purchasing company. The purchasing company here is Zomato. Now this is not like previous sum. In previous example, you see total benefit was given. Benefit to the vendor was given. Balance we said benefit to the purchaser. It was ascertainable easily. But now it is not ascertainable. You know the value of purchasing company and you know the value of the merged entity. That means 100 lakh Zomato valuation is now 150 lakh. That means 50 lakh is the increase in valuation. But that 50 lakh will not be enjoyed only by Zomato shareholders. It will be enjoyed by Zomato plus Blinkit shareholders who are now part of the same company. No, 1 second. You copy later. First understand what I'm saying. Listen. Value of the purchasing company is 100 lakh. Pre-merger, Zomato was 100 lakh. Value of the merged entity, post-merger, it is 150 lakh. That means simple, 50 lakh is increase in valuation. But this 50 lakh, I cannot say will be fully enjoyed by only old Zomato shareholders. Because this 50 lakh benefit will be shared between old Zomato shareholders plus the new shareholders who came from Blinkit. Unlike previous question, we do not know that breakup. That we have to do. Able to follow? I quickly repeat, please follow the data. Value of purchasing company 100 lakh. This means Zomato before merger. Value of the merged entity, that means this is Zomato after merger. That means straight away if you see 100 lakh valuation became 150 lakh. That means old Zomato shareholders, they see our company valuation is going up by 50 lakh. But that 50 lakh benefit will not be only to the old shareholders. Now this 50 lakh extra benefit will be enjoyed even by the new people. But we do not know how much is the benefit enjoyed by new people. That's what was there in the previous slide. If it is directly ascertainable, easy to do. But here it is not directly ascertainable. We'll have to do some calculations. Following, first copy the example. Value of purchasing company, obviously before merger. Value of merged company, obviously after merger. They won't say before, after. You should understand. Sometimes they use the word standalone value, merged value. Standalone is independent values, merged is together. 100, 150. Number of shares of purchasing company. That means old shares of Zomato alone. Number of shares of merged entity 12 lakh. This has to be more than old because now you have to issue shares to the shareholders of Blinkit. Correct? Data is okay. Now please answer in Calci. Do this. How much was value before merger? How many shares were there? That means if you simply do 100 lakh by 10, you'll get to know kind of value per share before merger. Hello. Post merger, what is the valuation? 150. But that will not be enjoyed by just 10 lakh people. That will be enjoyed by 12 lakh people. If you divide by 12, basically value by number of share will give you value per share. What's the number? How much was before? The 2.5 is the extra value that each shareholder of Zomato got now. Able to follow? Start. Solution. This line, if you do not want to write, it's okay. Total benefit of merger is not determinable. This has to be done with some calculation. First two lines, if you don't want to copy, totally okay. Wealth of the shareholders before merger is compared with wealth of the shareholders after merger. Before break, I gave you this example. You were holding 10 shares, 180 rupee, it became 220. Your wealth increased. Same way. See this? Third line onwards, you can copy wealth of existing shareholders before merger. 100 lakhs into 100%. This is obvious because 100% was held by them. You can do it on per share basis. What you did in Calci was per share. We can do it in total. Either way, it's okay. Now tell me, wealth of the old shareholders after merger, value of company is 150 lakh, but you are not going to hold 100%. Correct? Yes. 150 lakh into, you are holding only 10 by 12 of that, because 2 by 12 is Blinkit shareholders. It is 125 lakh. What you did in Calci was per share, 10 versus 12.5. What we are doing is in total. Therefore, benefit to purchasing company 125 minus 100, 25 lakh. What we did was per share 2.5, and then if you multiply that with 10 lakh share, you will come to same 25 lakh. With this base learning, we can now start with classwork number 1. Come to page 149. Yes. A Limited is considering merging with B Limited. There are, underline, no gains from merging. Synergy gain or advantage is not there. Complete the following table if A Limited wishes an EPS of, underline, 2.8 after merger. This is EPS post merger. They have given some details to you. Earning after tax 1 million is 10 lakh. So 0.1 million is 1 lakh. This is 1 lakh and this is 2.5 lakh. Shares outstanding, market price of the share, earning per share, P ratio, market value, A Limited, market value, B Limited. Requirement, sub question A, complete the above table. Now these question marks can be MCQs. Sir, why is it even a question? We'll just add A plus B and fill. Post merger, that should be the number. Can I do that? MPS 20 plus 12.5, 32.5, 50 plus this. No. Remember, shares outstanding, A Limited 50 will remain 50, but these guys 1 lakh may not become 1 lakh because we have to decide the exchange ratio. And if exchange ratio is 1:1, then this will be 1 lakh. Therefore, it's not. If it is addition, why will they create a question? No, I'm explaining this for a reason. Some students will read this, no gains from merging. No gain from merging doesn't mean everything you add. Hello? What if they give one thing, something like this, 15% NP ratio, 15% NP ratio? Will you take 30% NP ratio? That's the last thing you can do. This addition is wrong. No gain doesn't mean you just add all. Then it is not, you are not buying a company at book value. First understand. There is market price given. Post merger market price may change. Values will change. There is benefit to A, maybe benefit to B. All of that will have to work out. Never understand this line. No gains from merging doesn't mean it is summation of everything. If that's the case, then this will never become a question. And okay, think this way, earning per share 2 rupee 2.5. If it was just addition of the two, this should become 4.5. This is earning per share. This cannot be added like this. No meaning if I add earning per share of A plus earning per share of B, that won't be earning per two shares, correct? Hello? That addition has no meaning. I know you will not do this mistake, but those who are doing this mistake is because of the first line. They read this, there are no gains, then they immediately what goes to their mind, no gains. That means everything is just addition of two numbers. That's not correct. No gain doesn't mean addition of two numbers, right? Now please tell me, what are the hints that we have? You have the merged entity earning per share, and you have EAT, and they said there are no gains from merging. Therefore, we can start off from there. If there are no gains, my earning plus your earning will be the combined entity earning. And from there, if you have the EPS, we can find out how many shares should be there. In that, we already have our own shares. The balance share should be allotted to the other company. First of all, my target is to fill these question marks. Once that is done, then we will be able to complete the exchange ratio and the cost of the merger. Clear? What if they say there is 5% synergy gain? Something like, I think we have it in, see this on screen, nothing in textbook. Question number 3, they have given earning per share, market price, number of shares, and then they are saying there is expected synergy gain. That means now you cannot say my earning plus that earning together will be total earning. That total plus there is a gain. Now in this question they did not say, the one that we are doing, there is no reference to any synergy advantages. Therefore we can start with the understanding that earning of A plus earning of B will be the total earning of AB Limited. By the way, AB Limited, they haven't given the name. Therefore let's not write AB Limited. Maybe they'll come up with a new name, we don't know. So I'll write it as merged entity. First we have to complete all these question marks, and then we'll go to the exchange ratio. Start. Yes. Sub question A. Since there is no synergy gain, it's not there on slide. Please write. Since there is no synergy gain, earnings of merged firm will be, earning of merged firm will be equal to, go to the question. If you do not have any synergy benefit, it will be simply 1 lakh plus 2.5 lakhs, total 3 lakh 50,000. Correct? Anyway, this was one of their question marks, so we are completing that itself. If they say there is 5% gain, then on 3 lakh 50 I will add that gain. Yes. Tell me what is the other data that I can use. EPS of the merged entity is given. If you have EPS and you know the total earnings, you can find out number of shares of merged entity. That's also one of the question marks anyway. Continue. Number of shares of merged entity. Number of shares of merged entity can be calculated this way. 3.5 lakh total earning divided by 2.8 per share earnings. That means there should be 1 lakh 25,000 shares. But if you go to the question, presently A Limited has 50,000, B has 1 lakh. Again, I am repeating, 50,000 of A we should not touch. What can change is the shares to be issued to Blinkit. Zomato's shareholding will not change. They will remain as it is. Correct? Now tell me, if you see the question, 50,000 and they have 1 lakh, but the total is now only 1 lakh 25,000. That means we will be issuing 75,000. Don't write it now. That is second sub question. 75,000 shares. But how many shares they have before merger? 1 lakh. That means exchange ratio will be 75 is to 100, or 3 is to 4, or 0.75 is to 1. That is the later part. Now tell me, which is the other question mark? EAT done. Share outstanding we calculated. Then they need market price, then they have P ratio, and then you have market value. Continue. Total market value of the merged firm. Total market value of the merged firm is equal to. Go to the question. Do we know independent market values? 10 lakh and 12 lakh 50,000. And did they say any synergy gain? No. That means valuation will not increase. It will be simply sum of 2. 10 plus 12.5. If there are two companies and they are merging without synergy gain, then it should be simply addition of my value plus your value. This comes to what now? 22.5. Correct? Now this is the value. We also know number of shares. In Calci, if I do 22 lakh 50,000 value by number of shares, I will get to know market price per share post merger. Yes. By the way, how do I get value of the shares? Number of share into value per share. That means if I divide now, next line, market price of the merged entity 22 lakh 50,000 divided by 125. What's the number? 18. Go back to the question. The only question mark we haven't answered is PE ratio. For PE ratio, if you have MPS and EPS, it will be simply 18 rupee divided by 2.8 rupee. 18 by 2.8, 6.43, and P ratio is written in times. It's also called as P multiple. Remember, 10x means 10 times. Doubt? I'll explain. With the sum, I'll explain. Doubt is on synergy gain. How do we understand what is the meaning of that plus 5%? We'll learn with the sum. Anyway, you have a question maybe next to next. Done. This is only sub question A. Complete the above table. There are 5 question marks and we answered. Second sub question is calculate the exchange ratio. By the way, how many shares were there in B Limited before merger? 1 lakh. And you are saying total shares of the merged firm is 125. In that 50 is own shares. That means balance to be issued is 75. Start sub question B. Easy part. Number of shares to be issued to the shareholders of B Limited. Total we will have 125,000. Out of that, our own shares are 50,000. That means to new people we are issuing 75,000 shares, but they before had 1 lakh. That means the ratio should be 75 is to 100. Correct? 75 is to 100 can be written as 3 is to 4. exchange ratio, you can write it as 0.75 is to 1 or 3 is to 4, 75 is to 100, anything is okay. Sub question C, cost of merger to A Limited. We discussed a lot of examples and slides before coming to this sum. How to do cost of merger to A Limited? You have to compare what was the value of that B Limited before and how much are you paying, but you're not paying cash, you're issuing shares. Remember, there were two arrow marks. If you pay cash, it is easy, cash paid minus value taken over, but here you are issuing shares, value of the shares issued. Remember that alpha part, it is that second case. You will not find many questions on cash payment, I already told you, because that's not how real world works. 99, if question is silent, you always go by understanding that it is share to share exchange, it's not cash paid. Please start. Sub question C, cost of the merger to A can be understood as benefit to B. Cost to me is benefit to you. And how to find out benefit to B? If you find out how much is the values that they're getting now and compare that with what value they had before, the difference becomes their benefit. Start. They are holding 75,000 out of 1,25,000. Remember that alpha, correct? This will be their holding power in the new company. And what is the value of the merged entity, by the way? 22,50,000. Correct? Or if you are comfortable in the other style, 22,50,000 into 75 by 125 minus what was their independent valuation before merger? 12,50,000. Now they're getting shares which are worth 13,50,000. Correct? Minus their independent valuation was 12.5 lakh. So they got a benefit of 1 lakh rupee. What is the other way they can print this question? Instead of issuing shares in 3:4 ratio, we paid them cash of 13,50,000. Then it will be very easy, 13,50,000 minus 12,50,000. But they won't give cash payment, very, very rare cash payment adjustments, because it's easy. That's why it's rare. Then you don't have to do all this calculations at all. Yes, question number 2. Yes. B Limited is a highly successful company and wishes to expand by acquiring other firms. It is expected Its expected high growth in earnings and dividend is reflected in its PE ratio of 17. Remember, when they say in its PE ratio, that means this is PE ratio before merger. I'm writing BM, before merger. The board of directors of B Limited has been advised that if it were to take over firms with lower PE ratio than its own, that means if you are buying another company whose PE ratio is less than 17, using a share for share exchange ratio, then it could increase its reported EPS, underline the wording, increase in its EPS. This increase will happen after merger, not before merger. Continue. C Limited has been suggested as a possible target for takeover. Now this is our Blinkit, which has a P ratio of 10. Again, this is the P ratio of that company before merger. And they have 1 lakh shares in issue with a share price of 15. All these numbers are before merger. 15 rupees their market price, 1 lakh is the shares that they have, and their P ratio is 10. B Limited has 5 lakh shares in issue with share price of 12. That means even this data is before merger. They have their own 5 lakh shares and market price is 12 rupee. Calculate the change in EPS of B Limited if it acquires the entire C Limited by issuing shares at its market price of 12 rupee, underline at its market price of 12 rupee. My suggestion before we start the answer, the data is not in one proper place. You will get confused and take wrong ratios and wrong numbers. Better we put one working note and write all the data particulars: B Limited, C Limited. You have P ratio of both, market price of both, number of shares of both. And if you have P ratio, EPS, number of share, you can find out few more things. We can first put all the data in one place. Here I did not do because data was properly organized and easy to do. But here if you see, there are so many datas in different places. So what I'm saying, this in exam, if you don't want to do, it's okay. See what I'm writing on screen. I'm just asking you to do this: B Limited, C Limited, all the data before merger. Please tell me what all do I have. P ratio. Do I have P ratio of both? This is 17 and this P ratio is 10. Okay. What is the other data that I have? 1 lakh shares. So number of shares, and this is C Limited 1 lakh. And how many shares B has? 5 lakh. That is given here. And C Limited market price is 15. So I can even keep this 15 here, and this is 12 here. All okay? Now tell me, if you have P ratio and MPS, I think you can even show the EPS. What is the formula? P ratio is available, MPS is available. Correct? You can do EPS of this and you can do EPS of this. If we put all of this in one table, from here it becomes easy for us to solve the sum. Understanding? Data is not in one proper place. So better to first prepare one working note and put it in one easy table. Start. Working note 1. You write as basic computation. Basic computation. Make 3 columns. Particulars, B Limited, C Limited. Remember, when you are writing both the names, obviously it is before merger. After merger, where is C Limited? Correct? Oh. One by one. Just available data, you put it in a proper place first. P ratio, I can copy. But please go in the correct order. B Limited is 17. C Limited is 10. Then you have number of shares. But in the question, you have C Limited shares 1 lakh first. And then they have B Limited. Go slow. Put the data in right place. 5 lakh here, 1 lakh here. I also have market price. This is 12. This is 15. And you can actually do one more working. Tell me, if you have PE ratio and MPS, you can find out EPS. Correct? First, you know the formula of PE ratio is equal to MPS by EPS. For B Limited, left hand side is 17. Following 17 is equal to 12 by EPS. Go slow, take correct numbers. PE ratio is 17 times. Price is 12 rupee. If you cross multiply, you get the earnings per share before merger. Numbers are correct. 0.705. And again, look at the table that you have written. You have number of shares and you have EPS. If you do number of shares into EPS, you will get to know earning available to equity shareholders, EAT. Correct? That also you can do. Total earnings is equal to 5 lakh shares into 0.705. Here 1 lakh shares into 1.5, 1 lakh 50,000. This is what independent B and C are earning. Now go to the first line of the question. B Limited is planning to acquire C Limited. That means B Limited will have to issue shares. Read last line of the question. Calculate the change in EPS of B Limited. By the way, we already have the EPS of B Limited. Just now we calculated. EPS is 0.705. In future, that is after merger, whether this will be more than 0.705 or less than 0.705, that is what they want. And by the way, how are we issuing the shares? Please read last line. If it acquires the entire C Limited by issuing shares at its market price of 12 rupee. That means from here we will find out how many shares are to be issued. Did they mention any synergy gain anywhere in the question? No. Start. Working note 2. Tell me. We are taking over C Limited. Go to your table. How many shares they have? 1 lakh. Before merger 1 lakh. And what's the market value of one share? 15 rupee. That means their total value as of now is 15 lakh rupee. And if we want to buy that, we have to give them shares. We're not giving cash. And how many shares we have to issue, that depends on at what price we are issuing. Read last line of the question. They said you'll issue shares at 12 rupee. That means this 15 lakh rupee worth business we can buy if we issue them shares at our rate of 12. That will tell you how many shares you have to issue. Correct? Copy. Market value of C Limited is number of shares into market price per share. But we are not giving them cash of 15 lakh. We are giving them shares. If we are giving them cash and they say 18 lakh, here itself answer is ready. Correct? Taking a company worth 15 lakh by giving cash worth 18. Difference is the answer, but that's not happening here. We are issuing shares. Now comes the question, how many shares? That depends on at what price I'm issuing. Last line of the question says you are giving share which is worth 12 rupee. That means you have to issue them 1,25,000 shares. Go to your original data. How many shares they had before? No, not B Limited, C Limited. 1 lakh. And now they'll be getting how many? 1,25,000 shares. Correct? How many shares were there in B Limited before merger? And now how many will be there? 5 lakh plus 1,25,000. Correct? Sorry? Once, which line are you referring? Share for share exchange means we are not giving cash. It's not to share for share means what? You are holding share in Blinkit. I will give you Zomato share. I won't give you cash. They did not say share per share. They said share for share. It's share per share. It's not 1:1 ratio. Tit for tat. Okay. They did not say 1 per 1. Don't get confused. Share for share means you are holding share. I will give you share. How many? That we will work out now. Continue. 1,25,000 will be new shares. Therefore, number of shares of B after will be your own 5 lakh. That will not change. I will repeat this till the end of the topic. You should never change the number of shares of your own shareholders. Only new people will get shares. Repeatedly, people do mistake in this. They get that ratio. There were 1 lakh, it is 1,25,000. So everybody will get 1.25 for one. Own people, why will they get new shares? Continue. Total earnings of the merged firm, that is after merger, is equal to this you have in your table, 3,52,000 plus 1,50,000. They did not say synergy gain. That means there is no extra sales, no extra pat, no benefit. Now again, let this not be your doubt. If there is no synergy gain, why are we merging? I told you to kill competition also you will merge. Big Bazaar was stuck in this problem 2 years ago. Somebody wanted to take over, but then the takeover was not allowed. Even killing competition is not easy. Those who know this, now there is no more Big Bazaar. If you are aware, it was Future Group's company, and then Big Bazaar was stuck for this problem. Who should take over? Reliance was trying to, but then before that, Amazon had done a kind of deal with them, and this is what happened. To buy another company is not always to have some synergy gain. It is only because you don't want someone else to buy them. So better now only you buy. Understanding? If you don't buy, someone else will buy. By the way, your Swiggy Instamart was supposed to be bought by Flipkart. They did not buy. Swiggy guys offered them, we have something called Instamart. If you want to buy, buy. We are ready to kind of sell our one wing. Flipkart came for the discussion. I think they had couple of rounds, but then deal did not work out. Then only after that, Swiggy went ahead aggressively with its Instamart. Otherwise, Instamart was not their favorite wing a year back. Flipkart came, tried, because Flipkart, see again, same story. Flipkart can also do this 10 minutes delivery. Instead, if you already have a company which is doing Instamart, just buy that, just to kill the competition. They wanted to, but maybe the valuation was so high, they decided to take a step back. Now, Flipkart, which was once like a super popular app, they're not able to pick up to the kind of competition that is posed by these guys. Amazon, I think, was planning for 1 day, 24 hours delivery. Huh. They've improved because of the competition now. Because now people are comparing 10 versus 10 minute. How can you compete if your other guy is giving at 10 minutes? You can't, it's not easy. 10 minutes delivery, these guys, it's very, very difficult. Maybe Amazon was not expecting these companies to be accepted by people so fast. Amazon, what used to happen 2 3 years back, you order something next Thursday, they would ask your pin code, and depending upon that, next Thursday no stock available, or you have to set on alert there. The day stock is available, you give a notification, then I'll come and order. Now people don't have patience. I'm scared. Once you go to 10, going back is very difficult. Think, if all these 10 minutes delivery companies go, and then you have to wait, even 30 minutes sounds so late now. 30 minutes is not late actually, and you want new phone in 10 minutes, you get fan in 10 minutes, you get all ingredients in 10 minutes. Now they are talking, by the way, in the CNBC TV18 interview, they are talking about delivering food in 10 minutes. That will be the next thing to happen. That means you can start breakfast midway. If you want to have little more, you can order. Now it is you have to order and then wait to start the breakfast. Now after starting the breakfast in 10 minutes, if I say I order 3 idlis, when I'm eating second, I feel I need maybe one more idli. Now I can order. By the time I finish third, fourth will come. Once you make people used to these kind of things, some other company has a very tough entry point now. Nobody can now talk about even 1 day delivery. The moment you say 1 day delivery, they'll tell you the list. Look, 10 minutes, 11 minutes, 30 minutes, less than 24. 1 day sounds like too late. Anyway, we'll see. I have some worry. Someday, one or the other government will come with a regulation, and if not a full stop, a comma will be put on these companies for sure. Because the way those riders ride their two-wheelers, because the target is 9 minutes, 8 minutes, that too in Bangalore traffic. Those who know, if you have to cross South End Circle itself, 3 minutes is gone. And 9 minutes from the time you place the order is placed, somebody has to count, pack, bill, then a delivery guy should be there. He should ride in between 2 3 signals, and then he should come. Everything should happen in 9 minutes. If he's stuck in traffic also, it can get dragged. But these guys also get incentive if they deliver in time. First of all, two-wheeler riding is in Bangalore is next level. On top of that, these guys and most of these guys, you know what I'm saying. They don't drive safely, and it is not risk only to them. They will hit somebody. That guy is a law follower. Even he will be hit because of these. My doubt, some state government will first start this regulation that no app should promise less than 10, or they will start catching these boys, the delivery boys, and then put hefty penalty, and then these companies will only stop this 10 minutes delivery. I'm not sounding negative, but I have my own doubts on this 9 minute, 10 minute continuing. 30 minutes will continue, less than a day will continue, but then 9-10 minutes I have my own doubt. Literally, it should be within 1.5 kilometers from your house for the delivery to happen. That means in a city like Bangalore, how many dark stores you need? If every 1 kilometer you have to have one store, your warehousing cost will rise, correct? If it is 30 minutes, then say Jayanagar, JP Nagar, Banchankri, together you can have one. But if it has to be delivered within 9 minutes, in Jayanagar you need 10. It has to be within 9 to 10 minutes each. Then your warehousing cost will go up. One. Second, if it is not so near, then these riders have to come very fast. And then in Bangalore, the two bikes, the two in peak traffic, if they want to reach within 10-11 minutes, they have to skip, jump some signals, or go in one way. All of that you are seeing anyway. You don't need me to explain. My doubt, if don't want to say, for learning purpose I'm discussing, if some delivery boy meets with an accident and something like that happens and some other innocent guy dies because of the delivery boy going in wrong direction, etc., government will be serious and they will put a comma on this business. They won't say banned, but they will say you should not promise 10 minutes. They'll put a minimum saying no one should promise less than 30 or 45. Once they put that upper cap, then you will see some fall in the business, because in 30 minutes I can go walk and get that item. I'm doing it now because I have to walk and it takes more time. But if it is less than 30, then it is lucrative. More than 30, then people may not order so much. I think Karnataka government will be the first government to put a comma on this. I don't know how other state people, please tell me, is Bangalore bike riding the most scary one, or is it same in your states also? Hyderabad, I saw something. I don't want to say more. Then I started respecting Bangalore riders after that Hyderabad visit. I do not know. Other states, other cities, is the bike riding same even there? And bike riders are the number one, they should understand they are at highest risk. If they hit car or an auto, these guys will have more impact than the car guy. For him, it's just a repair of a vehicle part. For you, it's a repair of a body part. You should know, being a bike rider, you are at a higher risk, and these guys ride crazy, and most of these are youngsters. Can't even ask them go slow, etc. They say your uncle. Can't tell anything to them. And the competition is 9 minutes, 8 minutes. According to me, this is a problem in the whole Swiggy, Zomato, Zepto. The only problem statement I find right now, the risk is some state governments will first put a regulation on this. Then you will see some slowdown in this economy. As of now, it looks like anything is possible in 9 days, 9 minutes. I don't think this will uh, continue for too long. Yeah. Well, I am a Zomato shareholder, but I know there is this risk. Yeah. So total earnings, since there is no synergy gain, 502,941 EPS of the merged firm will be 502,941 divided by total number of shares will not be 5 lakh plus 1 lakh, because we are not giving them 1 lakh to 1 lakh, we're giving them 1 lakh 25. So EPS will be 0.804. How much was their EPS before merger, by the way? I think we did in our table here. Yes, 0.705. Read the last line. Calculate the change in the EPS of only B Limited CPS. They haven't asked for C Limited. So it will increase. Change in EPS would be from 0.705 to 0.804. As a result, can you please tell me the Exact number, how much is increase? 0. 0.099, is it? If you want to put it in percentage, 0.099 divided by, you have to divide by the starting point. Starting point is old one, so I'm writing here 0.099 divided by 0.705 into 100. The EPS will be up by what? Approximately 14%. They haven't asked in percentage, they only asked you the impact, whether it will go up or come down. Done. This converting this kind of data to table, from my side, strongly recommended, but this is not part of the main answer. If you do it in this way, it becomes easy and chances of mistakes will be less, because when data is not clear, we get confused unnecessarily. Question number 3. Yes. Here, this is a sum with synergy gain. A Limited believes that an earning per share of 6 rupee is possible if merger is implemented. That means, tell me, is this before merger or after merger? This is after merger EPS. From the following information, determine appropriate exchange ratio. That means they have asked us to decide what should be the exchange ratio. EPS of independent companies 5 and 5. This is what I'm saying. If they give data in the table form like this, it's easy. We can start the answer straight away. 5 and 5. MPS is 60 and 50. Now with MPS and EPS, if you want, you can show the P ratio. Number of shares 10 lakh and 8 lakh. Now number of share, if you multiply by EPS, you will get to know total earnings of A, total earnings of B. But after merger, it is not simply addition, because there is one more new line in the question, that there is a synergy gain of 5%. Correct? In calci, please. 10 lakh shares into 5 rupee. EPS of this company 50, I think. Correct? And 8 lakh into 5 rupee 40 lakh. That means total without any synergy story, like first and second question, will be 90 lakh. But you are expecting some synergy gain, the benefit. Able to follow? This is what changes the moment when they bring synergy gain. If synergy gain line was not there, I would have simply taken 50 plus 40 as 90. All okay? Start. Question 3. Expected total earnings after merger. Expected total earnings after merger. How to do? 10 lakh into 5 plus. Looks like there is a small mistake on slide. It's not 80 lakh into 5. 8 lakh into 5. Yes. This will be 90 lakh, but there is synergy gain of 5%. So it will be 94.5. Correct? And read first line of the question. They said it believes that an EPS of 6 is possible if merger is implemented. That means from this, if I divide 6, I'll get to know how many shares we will have after merger. Continue. EPS of the merged firm is equal to 6 rupee in bracket given in the question. If you know total earnings and you know the EPS, you can easily find out number of shares that should be there in the merged entity. 94.5 lakh divided by 6 rupee. What's the number? 1575000. Under this two arrow marks, tell me out of this, our own A limited shareholders are holding 10 lakh. That means balance 575000 will be issued to B limit. So I've written like this. You can draw two arrow marks. Your own shareholders will be 10 lakh. For outsiders, you will issue 575. But how many shares they were holding before merger? 8 lakh. That means now ratio will be 575,000 divided by 8 lakh. 575 divided by 8 lakh. This will be in decimals, but understand when you issue shares, you normally don't go by decimals. Yeah. 0.71875. Remember, in any ratio, when you write 0.71875, it should be understood as 0.71875 is to 1. For every 1 share held, you are issuing 0.71 share. They may add one more question. Suppose there was Mr. C who was a shareholder of B Limited. He was holding 10 shares. How many shares he'll get now? He will get 10 into 0.71, 7.1 share. But remember, it will have to be rounded off. Then it will be 7 shares. And for balance, they may give him cash. That's the only time this cash will come into picture, because you can't issue fractional shares. You will issue rounded off figure as share, and balance proportionate money you pay off as cash. If you remember, this similar sentence was there in the inter amalgamation accounting. They would issue this many share, and for the fraction they pay cash. That's the only time you bring in cash in a merger acquisition sum. Otherwise they would ask for shares only. Yes. Merger 4. K Limited is considering acquiring N Limited. The following information is available. K and N: earning after tax, number of equity shares, market price per share. Now, when you read the data like this with EAT and number of equity shares, you can find out EPS, and with EPS and MPS, you can find out PE ratio. Yeah, may not be needed in every sum, but when you read, you need to process the data in that manner. Exchange of equity shares for acquisition is underlined based on MPS. What does it mean? There itself in the question book, make a note. It means exchange ratio is based on market price of the share. Exchange ratio is based on market price of the share. What is the market price? 160 and 200. That means in the ratio 16 is to 20. I think it will come down to 4 is to 5. That will be the ratio. Yes. There is no synergy advantage available. That means when you merge two companies, total earnings will be 60 lakh plus 18 lakh. There will be no additional earning. Yesterday, I think last sum that we did, there was 5% synergy. And when we worked out new EPS, we added those two numbers, 10, correct, plus 8. Was it 10? This yesterday's answer, because there was 5% synergy, we took 10 plus 8, 18 lakh plus 5%. Now they're saying there is no synergy. That means when you merge these two entities, total EAT will be simply addition of these two. Question is, find out EPS of K Limited after merger. Anyway, after merger, there won't be N Limited. So if they say calculate EPS, they're talking about the continuing company, not the one that is going to be closed. Now tell me, to work out EPS, I need two numbers: total earning of the merged firm divided by total number of shares of the merged firm. Now since there is no synergy gain, addition of these two will give you the numerator, total earnings, to be divided by number of shares, but that will not be 12 lakh plus 3 lakh. 12 lakh will continue, but to these guys we have to issue shares, and the ratio is not 1:1. Ratio is 4 is to 5. Accordingly, you issue the share and then you get the EPS. Actually, this part of the question is easy. Find the exchange ratio so that the shareholders of N Limited would not be at a loss. This is actually a better part of the question. What does it mean? Find out exchange ratio in such a way that the N Limited shareholders are not at loss. As of now, N Limited shareholders, if you do 18 lakh divided by 3 lakh, are earning 6 rupee. In the merged entity, they may not get 6 rupee per share. They are saying no, they should get same 6 rupee. Then you change the exchange ratio. That means first sub question will work out based on MPS. Second, we have to find out the ratio so that the shareholders of N Limited are not at loss. Okay. Start question 4, sub question A. Since there is no synergy gain, total earnings of merged entity is equal to, what are the numbers? Simple, A plus B, no benefit, 60 lakh plus 18 lakh rupee. Done. Numerator is ready. You have it in the question. EAT 60 lakh, EAT 18 lakh. When you merge, it will be 18 plus 60, 78 lakhs. Next, it is given that share exchange ratio is based on market price. That is, what is the market price ratio? 160 is to 200. That is 16 is to 20 or 4 is to 5. That is, for every 5 shares held, comma, K Limited will issue 4 shares. Therefore, number of shares issued to shareholder of N Limited is equal to, go to the question, they already have 3 lakh into 4 by 5. This will be 2,40,000. K Limited's own 12 lakh will continue and new addition will be 2,40,000. Yesterday we have done. You will not issue shares to yourself, it will only to the new entrants. Therefore, total number of shares of K after merger will be old 12 lakh plus new 2,40,000. That comes to 1,440,000. Therefore, EPS of merged firm will be 78 lakh rupee. You already have it. No synergy, so it's simply addition of those two by 1,440,000, 5.42 rupee. Now, look at the data. K Limited earlier in Calciplease 60 lakh rupee EAT by 12 lakh rupee, 12 lakh equity shares, those shareholders were earning 5 rupee EPS, but now they will also be earning 5.42. They are in a advantageous position. But look at N, 18 lakh rupee divided by 3 lakh. In their independent company, they were getting 6 rupee per share. But now because of the merger, they will get only 5.42 if you issue them exchange ratio 4:5. Correct? Now see what they're asking in sub question B. Find the exchange ratio so that the shareholders of N Limited would not be at loss. That means issue such number of shares wherein post merger also those guys should get same 6 rupee that they were getting before. Able to follow? There is an easy way to do this actually. How much was old DPS of K Limited? 60 lakh by 12 lakh. 5. And old DPS of N Limited? 18 by 3. That means it is 6. That means 5:6. That means if the exchange ratio is in EPS ratio, this is a shortcut actually. There's a long way to do. Let it be X and solve it. If EPS is considered as the ratio for exchange, then post merger they will be having the same earning per share. Let's see. Start sub question B. When there is no synergy gain, comma, to maintain the same earnings, exchange ratio should be based on EPS. Now, in the present case, I think you did in Calci, EPS of K 5 rupee and EPS of N 6 rupee. 60 lakh by 12 lakh, 18 lakh by 3 lakh. Who has better EPS before merger? N Limited. That means ratio won't be 5:6 by the way. They had higher earnings. Therefore, you have to allot them higher number of shares. That means it is 6:5. Till here is okay, and after this many get confused. It's not 5:6. We are earning less, they are earning more. That means more shares to be allotted to them. Correct? So it is 6:5. That means ratio should be 1.2:1. What were we offering was 4:5. 4:5 meaning 0.8:1. So we said for every 1 share, you will get 0.8 shares. Now what should be the answer? For every 1 share held, you will be getting 1.2 shares. Now listen, what was our target? Read. Find out the ratio so that the shareholders of N Limited would not be at loss. Correct? Now let's check whether this will give them same EPS or not. If you go by 1.2:1, how many shares they were holding before? 3 lakh. And you will be issuing how many shares? 3 lakh into 1.2. 3 lakh 60,000. Now calculate EPS. 60 lakh by 18 lakh. 16 lakh plus 18 lakh. 16 lakh. 60, I'm saying it may sound like 16. Thanks to my nose, it is 60 plus 18. Divided by how many shares? 12 plus 3 lakh 60. 15 lakh 60,000. How much is the EPS? 5 rupee. 1 second. How much is the EPS? 5. 5 per share. But we are not allotting 1:1. We are allotting 1.2. That means it's 5 into 1.2. They will be getting the same 6 rupee that they were getting earlier. This justification they have not asked. Correct? See this. Understand this. You have the justification story here. EPS of N Limited before merger 6 rupee. This we got by doing 18 lakh by 3 lakh. EPS of K Limited after merger will be, just now you did, 78 lakh divided by 12 lakh plus 3 lakh into 1.2, which is 3 lakh 60,000. That means EPS will be 5. A shareholder of N Limited holding 1 share of N before merger will now be holding 1.2 shares of K after merger. Understand the sentence. You were a shareholder of N Limited before merger. For 1 share you are getting 5 rupee. But now you'll not be holding one share, you'll be holding 1.2 shares. Think of someone holding 100 shares. Earlier, how much was his income? 100 into 6. But now he won't be holding 100, he'll be holding 120. And 120 into 5 will come to same 600. Able to follow this? Will have to copy. Please understand, I'm repeating. Suppose there was a shareholder in the N Limited. He was earlier holding 100 shares. And how much was the EPS of the old company? 6 rupee. That means he was earning a total of 600. But just now you got to know in the new company EPS is only 5 rupee. But this guy won't be having 100 shares. He will be now having 120 shares. That means he'll still be getting the same amount. And this is what they said. Read, find out the exchange ratio in such a manner that the shareholder of N Limited is not at loss. Yes, per share has come down, but then number of shares have also gone up. Earlier you were earning 100, now you'll be, sorry, 600, and now you'll also be earning same 600. This is explained on per share basis here. Look at this. It says 6 rupee earlier, now it will be 5 rupee, but you won't be holding 1, you'll be holding 1.2. So earlier it is 6 rupee into 1 share, now 5 rupee, but you'll be holding 1.2 shares. That means at the end you'll be getting same 6 rupee. I took an example of a shareholder holding 100 shares. 100 into 6 will now be 120 into 5. That's what I told you. The longer route will be let the number of new shares be X and then work out. Then also you'll get to know new shares to be issued will be 3,60,000. And then 360 by 3 lakh will be same 1 point. No, no, they did not say you should follow 1:1 ratio. 78 lakh. Huh. No. If you do 6 rupee, then the shareholders of K and shareholders of N both will get 6 rupee. Please understand. See, listen. Two ways of looking at it. Earlier, you are working for 8 hours a day and you are paid 1000 rupee per hour. You were getting 8,000. Now I want you to earn same 8,000. Now hourly rate has come down to 800. Then what is the way? I have to give you more number of hours. I want this to be same, not this to be same. Understanding? It's like quantity into rate is value, correct? You want same value. Rate may come down, then you issue additional quantity. Or if quantity comes down, you have to increase the rate. Yes, so earlier you were holding, following same example, you are holding 100 shares, you are getting 100 into 6. Now you are going to get only 5. Now if you say, sir, this should also be 6, and then you will be getting 120 shares, then your earning will be more than what was in the past. Correct? They did not say you have to improve their earning. They only said read the last line, would not be at any loss. They were getting 600, ensure they get same 600. They were holding 6, sorry, they were holding 100. You are making it 120. Anyway, 6 has come down to 5. They're going to get the same number. Yes. I want you to copy this justification properly. Class note, this is justification. Done. For your reference, just write two more lines. Suppose Mr. A was holding 100 shares in N Limited. Suppose Mr. A was holding 100 shares in N Limited, comma, next line. His total earnings before merger. His total earnings before merger is equal to 100 into 6 is equal to 600. Next line. His total earnings after merger is equal to 100 into 1.2 into 5. That will be same 600. Correct. This is where the main problem comes. If you are the purchasing company, you want to issue as less shares as possible. But if you are a selling company, Blinkit shareholders, they want to get as many shares as possible. And most of the deals will come till here. And then because of the exchange ratio, they won't continue beyond this point. Definitely think, if you're a Zomato shareholder, why do you want more shareholders to get added? Yes, new companies getting added, revenue will go up, profits will go up, shareholders will increase. But then if you agree to a big ratio, something like for every one share held, I'm giving you 2 shares, 3 shares, 5 shares, then next year more new people will be in your AGM than the old people. Reverse, think, if you're a Blinkit shareholder, because you're holding 1 share, if they say we will give you zero point 0.8 shares, then though you're becoming a shareholder of a new company, you'll be less powerful, because for 100 shares you're getting only 80. So you want to get more shares, they want to give less shares. Most of the M&A deals are stuck here. They won't be in a position to come to an agreeable number. They drag it for months together, and unless one of them decide to change their mind, then deals will not even continue. If you see the next question in textbook, look at subquestion A and B, merger 5. What is the maximum exchange ratio acceptable to shareholders of A? Subquestion B, what is the minimum exchange ratio acceptable to shareholder of B? This is exactly what I told you. The Zomato shareholders do not want to give more than a certain number. Blinkit shareholders do not want to accept less than a certain number. Then they fight on table, in email, and then this deal will get dragged for months together. Yeah. Question number 5. Before this, write a note or heading. You write the heading. Issues in exchange ratio. In notebook, heading. Issues in exchange ratio. 2-3 bullet points, one by one. Assume A Limited is planning to acquire B Limited. A Limited is planning to acquire B Limited. Full stop. Next line. Shareholders of A Limited will think in their favor and offer as less shares as possible to shareholders of B Limited. Next point. Whereas shareholders of B Limited will negotiate for a high exchange ratio so that they get more number of shares in the merged entity. Last point, this is where most of the M&A deals, most of the M&A deals will get stuck, will get stuck. Full stop. Stuck and then gets dragged 1 month, 2 months, 3 rounds meeting, 5 rounds meeting, and finally somebody has to agree. When you go for a shopping of item which has no MRP printed, you want to buy it at as low as possible, seller wants to sell it at as high as possible. How long will it get dragged? He offers 1000, you say 600, you come to 650, they come to 950, then you act, they act. How long will it continue? Depends on you and that guy. Depends on your negotiation skill. If you've attended the GMCS negotiation class properly, then you'll know how to bargain. But this is not easy. Here, if you are buying something in Jayanagar 4 block market, you know I'm starting with 600, but you won't agree for 600. Both the people, they're aware starting point is a joke. They know you won't buy at 1000, you know he won't sell at 600. But if you start from 800, they'll drag you to 900. So you start from this end, they start from that end. Exactly same happens in an exchange ratio. The buying company will say, I'll give you 1:1. For one share held, I'll give you one share here. They say, no, we need 3:1. For every one share we are holding, we need 3 shares. And then finally they negotiate just the way you are going to negotiate. I think the other day I told you something, but that day we did not have time. Suddenly I recalled it. I told you there are some countries where there is no MRP printed on the goods, correct? Very, very interesting development. I want you to, this is totally not related to exam and question paper. Most of the American FMCG items come without MRP. Okay. So you go to that place that day, in the rack where they've kept the items, on rack there is a display price. And if you pick it up at that rate, that is the rate. 5 minutes you go here and there and come, that rate may change. That means same item in 2 different stores may be getting sold at 2 different prices. Now, how will they decide what should be the price for that particular item in that location on that day to you, that customer? For this, there are companies and their expertise in data analysis. Okay, they hire a lot of finance professionals also, because only you can find out how much will be the margin, how many quantities can be sold if price changes, and so on. In India also it happens, but then not as frequently as they do. Here it is festival offer, 2 days, new price. After that, back to old price. Their price can change every day. Price can change from customer to customer. He was there, he bought, he went home. 10 minutes later, I come to the same store, pick up the same item. By then, MRP may be, there's no MRP, selling price basically. Selling price may be different. Now, on what basis do they change this price? When to change? Who is changing? Who is keeping the data track minute to minute? All of this, one, they use AI to see the demand and the speed of movement of the item. Second, they track who is buying and how desperate you are to buy, because every time you enter a store in say Walmart, heard of, they don't pay at the time of exit, they just walk. Okay, at the time of entry they would have swiped their credit card, then only the door will open and you enter. And then whatever shopping you do at the time of exit, you simply show that card to a device and then you walk, more like biometric. Here you show the card and go, and money will get auto debited. You don't have to stand in queue and do the billing. And billing happens at each rack. That is, you take one Coke bottle, there is a machine, so you scan it and then keep it in your bag. You do that billing counter guy job basically. And by the end you go, all the items are already scanned, and when you go, you scan your credit card. Some of them have even done this retina scanning. You don't even have to carry your credit card. First time when you go, only you have to sync these things: retina, fingerprint, like we have Aadhaar number, their identity number, mobile and credit card. You just have to sync all of this. After that, it's only you enter and they scan, they get to know your credit card number, your mobile number, and your past buying pattern, and they change the MRPs so rapidly. And their stores are not like ours here. Here it is difficult to do these things because it's very congested. At the same time, two people may be picking up same item, so you can't have one price to me, one price to him when both of us are picking at the same second. But there, the Walmart stores are like kilometers together long. People go for a morning walk and then buy something and come back. Yeah, you don't have to carry anything. I told you, all billing happens through the system. There are a lot of companies which are trying to work out this in other countries, and why it's not so popular or why you never got to know about this till today is in India you have MRP concept, so you cannot change the price whenever you want. And in India, when we do mass production, on that the price sticker is pasted and then only it goes to the store, so you can't be changing that sticker every minute. Practically not possible. There they don't print. Only thing printed is manufacturing date, expiry date, company. MRP is decided at that point of time. And I want you to read about this new development, how, because every time you change the price, your profit margin will change. That means they need a lot of finance guys to decide what should be the lowest price, what should be the highest price, weekend what should be the price, weekday what should be the price, morning what's the price, evening what's the, everything requires understanding of margins. And if you change the price and margins are down, volume has to go up. That means you should be able to analyze whether by changing the price my quantity volume can go up or not. So they analyze the data of every individual customer. If I enter, they know I am not price sensitive, so they change the price. By the time I reach there, price would be new. And then if he goes, he is quality conscious, not price conscious, then they'll make sure that the price of the best quality item is slightly higher, because he's not worried about high price, low price. He will go and pick up only that item because they have seen his past buying. So they have huge data, correct? One guy goes to DMart, just think in Indian context, one guy goes to DMart, does the shopping of monthly grocery like this, everybody, every single day, into 365 days, into that many DMarts in the country. That Excel sheet must be big, very, very big. And then they capture the data on customer to customer basis. And unlike India, their people don't change their mobile number every now and then, the credit cards every now and then. They have one for very long time. So if I am using the same mobile phone from last 10 years, every time I go for billing and then my mobile number is captured, they know which item I have been buying from last 10 years. So they will even predict when will be my next visit, because they know the pattern. Every month on 10th afternoon I come here, and this is the trend from last 12 months. That means they know when I'll be coming next and which item I'll be buying. They make sure that if there is a shortage of stock, that is refilled immediately, because they know I'll be coming. Even before I go, they know I'm going to be there at that time. So this is how the data is being used today. They may not share it to others, but then they can use it for themselves, and MRP can be changed. And this is called dynamic pricing policy. In US, most of the stores, I took Walmart as one example, there are many like this, and they are tying up with companies which can help them deciding price. Shampoo comes from one company, sold by Walmart. In between, there is some other guy who is deciding the prices, and for that, they're hiring a lot of finance experts who also has good understanding of the big data, because you have to analyze so much of data and then decide the pricing. So whoever is interested in doing career in a non-audit, non-tax line, you should be aware of these things. Please read, and anytime if you get a chance to attend anything on AI, big data, only if you are interested in this field, please start attending from now itself, because your competition is not with me. Your competition is someone who is in 8th standard now, correct? And they'll be learning stock market in their 10th or 11th itself. So you will be much late and slow. Your competition in future will be with those new guys, and if they are smarter, faster than you, right, then you will lose your market value, in simple sentence. Yeah. Therefore, more than knowing what your boss is doing, you should know what the next gen will be doing. So your competition will never be with your boss. Don't think that way. Yeah. So anyone interested in big data, AI, you should follow these news. And this is in America. In Europe, in some countries they have dynamic pricing. In some places it is MRP. Asian countries are all with MRP. China, organized market is MRP, unorganized is without MRP. That means you can get same mouse, same laptop in an organized manner in a unorganized place, second hand market and all of this. There the price is again dynamic pricing. It's all based on how you negotiate. In India, even unorganized manner, they put one MRP sticker, handwritten selling price. So that becomes a kind of uh, dynamic pricing, because if it is not printed with a barcode, then you know it is written by owner. I can, you know, fight with him. Someday this may happen in India also. By then, if you are prepared with the knowledge, if you have that awareness, then it will be good. And they're hiring CAs not only from US, they're hiring across. Yeah. How did I get to know? One of my friend is already working on this. He's a consultant giving financial advisory service to DMart. He is one guy among a big team, and he did not show me the Excel sheet, but he explained me in a manner I could visualize what he's trying to explain. So this dynamic pricing requires AI knowledge, big data knowledge, definitely Excel sheet, no question in that, and understanding of pricing and costing. Okay, whoever is interested in non old style CA practice, you should know about AI, about chat GPT, about big data. Take this advice very, very seriously. By the time you come out in the job market as a CA, he is also CA, she is also CA. If I am hiring, I need something extra between them. Both of them have cleared the exam, same articleship, same rule. Then why will I hire somebody? Either through interview, I'll decide their ability, or I want to know whether they have any other skill which the other candidate is not having. And the other skill now will not be I know all section numbers 1, 2, 3, 4 up to 299 in income tax, that there are 1,000 people already in the market. Correct? Competing in income tax is not easy today. There's so many people already in the game. GST competition was possible 5 years ago because that was new. Now there are so many practicing CAs who are experts in GST. So find something which will have value 5 years later and not which had value 5 years ago. So when you're choosing your expertise, you should know what is the new thing that is happening. And ICA conducts a lot of study circle meets and training even to students on this. Saturday, Sundays you have on AI, chat GPT and basics. There are a lot of YouTube content available. But if you go to CA Institute, advantage is it will be from finance angle more than the general chat GPT learning. And by the way, all those school kids use chat GPT. Yeah, we are all dumb fellows in front of them, to be honest. They're much smarter than you and me. You should be more scared, not me. Yeah, your competition is with them. So they have stock market knowledge already. They're learning these things faster than you. They have better tech advantage over you. But they are lazy. That is one advantage that you have over them. Yeah, you are lazier than me. So this is one side advantage, one side disadvantage. So we will have more lazy and fast people. My opinion. So please, those who are interested, this dynamic pricing policy and US MRP, non-MRP billing. About this, watch, read. You will surely get excited based on how they change the pricing and if you're interested in the subject. And then please, whenever time permits, if your exam is not in next 1 year, learn these things without fail. Income tax section you can mug up later. There are already thousands of people in Bangalore who are income tax experts. Okay. Yes. Question number 5. Market important. A Limited plans to acquire B Limited. The following information is available. Particulars A and B. Total current earnings 15 million, 20 million. Number of shares 20 million, 10 million. With this you can do EPS. And then MPS 30 and 20. With this you can get PE ratio. Most of the questions, these basic 3 data points will be available. Now read properly. What is the maximum exchange ratio acceptable to the shareholders of A? because they want to give as less shares as possible. So what is the maximum number that they will be okay to offer? If PE ratio of the underlying combined entity is 12 and there is no synergy gain. This is one part. Second, what is the minimum exchange ratio acceptable to shareholders of B if the PE ratio of the combined entity is 11 and there is a synergy gain of 5%? Because from B limited angle, they will have a minimum number. They say below this, if you are talking, I am not selling my company. Correct? I need minimum this, talk only more than this number. But the buying company will say this is the maximum I can give you. Above this, even one share you cannot ask. That's why it is maximum from A limited's angle and minimum from B limited angle. Leave second sub question. First sub question now. Tell me, maximum exchange ratio acceptable to shareholder of A limited. How to work this out? If you are a shareholder of Zomato, tell me what is in your mind when you're acquiring Blinkit. New people will come, and if new people are getting added to number of shares, then the EPS may fall. That too, there is no synergy gain in sub question A. All that you want to ensure is, look, whatever I was earning before merger, at least that much I should be earning after merger. Correct? You may not get extra, but you do not want to lose. And what will be in the minds of sub question B now? B limited shareholders, even they will think exactly same. Whatever I was earning in Blinkit, at least that much I should be able to earn. So that means none of them are ready to lose. That means you will have two different exchange ratio answer now. They may offer 1:1. These guys may ask 2:1. And that is a note that you have written. After that, they have to sit and negotiate. Whoever bargains well, the final exchange ratio will be decided. Start. Sub question A. Very important question. Go slow. Maximum exchange ratio acceptable to the shareholders of A Limited would be the exchange ratio with respect to which in inverted comma, I told you just now, wealth of the shareholder before merger and his wealth after merger would remain same. So he will not be ready to give you a share in such a manner that his wealth goes down. His wealth before and his wealth after should be same. That's the maximum number of shares that he can issue to you. Let us assume that the required exchange ratio is X. That means they are ready to offer you X shares for every one share held. Because we have to decide the ratio, we do not know the number. This next line, if you want to copy, you copy, otherwise it's okay. A shareholder of A Limited holding one share of A will be holding one share of A Limited after merger. Why I told you, if you want, you copy. Shareholder of A will not get free shares anyway. It's not a printing mistake. If I am Zomato shareholder, my shareholding won't change. Correct? Wealth of such shareholder before merger is equal to. Guys, I hope there is no confusion in the previous sentence. Shareholder of A Limited holding one share before will be holding same one share. He won't get extra shares. Correct? So how to calculate how much was his wealth before merger? Go to the question. If he was holding one share, MPS of the share is 30 rupee. Correct? That means if you are holding 100 into 30, you are holding 1000 into 30. But in future, 1000 will remain 1000, but 30 may not remain 30. Wealth of such shareholder after merger. Wealth of such shareholder after merger would be, I want you to think and tell me how to do this. Earlier one share was worth 30 rupee. Correct? Tell me how to calculate how much will be the market price of the share. That is your wealth. Market price of the share after merger. How to do? Go to the question. Do you have PE ratio? That means if you find out EPS of the merged entity and then multiply by PE ratio, you will get to know market price per share of the merged entity. No, this is not as easy as it appears. Listen carefully. You have the PE ratio of the merged entity. If you find out EPS of merged entity into that PE ratio, what? 12. That will give you the answer. That means now you should find out EPS. Tell me to find out EPS, what data I have? Go to the question in table. Total current earnings 50 million plus 20 million. No synergy gain anyway. That will be 70 million. 70 million divided by what? Number of shares in the merged entity. And how to get that? You already have 20 million of A, plus you will not be writing exact 10 million. If you write 10 million, then you're agreeing 1:1 ratio that you haven't decided. Able to follow? And just now we have written, let the number of share held in the new company be X. The ratio is X. That means now equation looks something like this. 50 million plus 20 million numerator divided by our own shareholders are 20 million plus 10 million into X. That's the ratio. That will give you EPS. That if you multiply by the P ratio 12, EPS into P ratio will give you MPS. And that should be 30, by the way. That should be 30 because he doesn't want his wealth to go. How do you measure wealth of somebody? Depending on the assets that he's holding. For a shareholder, his asset is the share and its share price is his wealth. Able to follow? I repeat. 50 million plus 20 million, 70 million will be total earnings divided by old shareholders are 20 million plus 10 million into X that we haven't decided. This will give you EPS. That into P ratio is 12 and this should give you 30 rupee MPS post merger. Now you will have to work out that equation and get the number X. Suppose X comes to 0.8. What is the meaning? Exchange ratio will be 0.8 is to 1. That means if you are holding one share in B Limited, I will give you 0.8 shares. So that MPS of the share will remain 30. I am anyway holding 1. I'll continue to hold 1. You are holding 1. I'll give you only 0.8. Clear? Start writing. This equation you have to understand properly. Earnings of the merged firm in million is 50 plus 20. 70 million. Number of shares of merged entity. This you can't copy from question. Old 20 million will continue plus these new 10 million shares will get X number of shares. 10 into X, 10X. Therefore, understand properly. EPS of the merged firm will be, tell me what, 70 million divided by 20 plus 10X. All are in millions, so you can write it this way. Do we know the P ratio of the merged entity? Yes, that means MPS of the merged entity is equal to 70 by 20 plus 10x, which will give you EPS. That multiplied by, what's the combined entity P ratio? 12 times this into 12. And that we want it to be 30. Correct? Continue. Wealth of the shareholder after merger should be same. This line it's okay if you don't want to write. MPS should be same, 30. Therefore the equation. I was holding one share worth 30. I want 30 to remain 30 only because my one share is anyway not changing. What is the equation? 70 by 20 plus 10x into 12 should be equal to 30. Solve the equation. Sorry, this will be 840. On solving the equation, you get value of x as 0.8. Is it okay? Anyone having doubt? How did we get that 840 suddenly? Hope no. Yeah. Guys, a by b into c. C means c by 1. So you can do a into c. No problem. Mistake also, we should maintain some good level. Ratio, at least in final, don't mess up. Yeah. If you're not sure, then put the number and see. At least to get double confirmation. How many shares they had earlier? 10. Now you are giving 10 into 0.8. That means it will be 8 in calci. 70 by 28. Correct? Into 12 should be equal to 30. Equation is correct. This we should not do. Those who are not comfortable with equation, at least you pause and check and then continue. Yeah. So the one second. So the maximum exchange ratio acceptable will be 0.8. 0.8 means 0.8 is to 1. Yes, sir. But EPS doesn't represent your wealth. Land is my asset. Earnings from land is like EPS. When they use the word wealth, wealth is the asset. Correct. But if you are a shareholder of Zomato, what will you think? Earlier my wealth was so much. In future also my wealth should be at least that much. Correct. Why will you sign a deal where you are, suppose you are holding 100 shares, 100 into 30. After signing the deal, 100 into 28 if it is happening. Why will you agree? You want at least 30. Anything more than 30 you are happy. That is because numbers are 20, 10, 2 is to 1. So it may not happen every time. Understand, wealth is MPS. Earning is EPS. I have a site, that is my wealth. From that site, I'm making some income. That is my earnings. Earnings are different. Wealth is different. Now tell me, so what's the final answer with this? We will call them and say, for every 1 share held by you, we will issue 0.8 shares. How many shares they are holding as of now? 10 lakh. 10 million. That means you'll be offering them 8 million shares. But tell me, how will they decide whether to accept this or not? They will also think in the exact same manner. Our wealth before merger, our wealth after merger should not again come down. That's the second sub question. Read. What is the minimum exchange ratio acceptable to the shareholders of B Limited if the PE ratio of the combined entity is 11 and they are expecting a synergy gain of 5%? Start. Now you have to change your role. You are not the shareholder of A, you are the shareholder of B. Now when you sit for bargaining, what should be the minimum exchange ratio? Same sentence. Minimum exchange ratio acceptable to A would be the ratio with respect to which wealth of the shareholders before and after would remain same. They will also think in the same manner. That means we'll have to do a similar calculation, but there is a synergy gain. So your PAT won't be just addition of two numbers. Yeah. How to do? You have done already once. Let's assume exchange ratio as I've kept Y because first one was X. Totally okay if you're writing X. What does it mean? A shareholder of B Limited holding 1 share in B will get Y number of shares in A. If you are holding one share in B Limited, you will get Y shares in A Limited. And how much was the market price, by the way? 20 rupee. B Limited share. Wealth of such shareholder before merger is 20. Copying, I'll wait. Now you try in the same manner we did first sub question. What to do? Wealth of such shareholder after merger will be. Tell me how to do. EPS of the merged entity. Copying. Okay. Those who have understood till this, you can try now. What to do? EPS of the merged entity multiplied by P ratio. That should be equal to 20 rupee. But EPS can't be just addition of 2. There is a synergy gain. Will you pause for a second? This synergy gain was not there in subquestion A. But there is synergy gain. Same data, A limited, B limited. Why is it happening? Because A limited shareholders think that by taking B limited, there is no additional benefit. But shareholders of B limited, they think if you take over us, then company will have a synergy gain. Obviously, one wants to overvalue himself. Correct? If you remember that day, 2 days back, in the Zomato Blinkit slide, the valuation that they did 4,447, it said it was 40% less than the earlier valuation done. That means Blinkit will definitely say that we are valued more. But Zomato is skeptical. This is how a negotiation is, correct? I have to boast myself, the other guy will try to demean myself. That's the way we do the negotiation. Therefore, these guys believe if we merge, then the merged entity will have synergy gain. But A Limited believes by taking B Limited, there is no synergy gain. This is what happens in most of the cases. Continue. Wealth of such shareholder after merger would be, tell me, same way, EPS into P ratio. But EPS is not addition of two earnings, it is plus some synergy. 50 plus 20 plus 5%. Number of shares of the merged entity, this you be careful. Those 20 million shares will not change. But you guys who are holding 10 will be issued Y number of shares for every one share held. Don't make it 20Y, 10Y. 20 will never change. That means now EPS will be 73.5 divided by 20 plus 10Y. And if you go to the question, they have given P ratio of the combined entity is 11. That means if you multiply, that should give you the MPS. Further, 73.5 into 11, 808.5 by 20 plus 10Y. And wealth will be this number, correct? Multiplied by, no, I think into Y is, no, that's incorrect there. Just continue this part. 808.5Y by 20 plus Y should be equal to 20. Anyone has solved full? Something looks wrong. Can you recheck once? No, recheck. I'm getting a doubt on the numbers here. Is it wrong then? 808.5 by 20 plus 10y. It should not be into. Okay, when you solved, how much did you get? 2 point. If you substitute that, are you getting same final answer? That is okay. Are you sure? Then looks like there is a mistake on slide. Let me recheck. 808.5 divided by 20 plus 10y. This will give you new EPS. This I think there is a mistake in the slide. How much is your answer, by the way? Yes, please update that. So the minimum exchange ratio acceptable to them would be, what is the correct number? 2.04. So for every one share held, they want 2.04 shares. If you substitute, have you rechecked? Is it matching with 20? However, I'll recheck this today. Yeah. Now, how many shares you want then, as per the deal? You want 2 plus some shares. And how much are they offering, by the way, in first answer? 0.8. And this is what I'm trying to tell you. This is where the deal gets stuck. They say for 100 shares, I'll give you 80. And you say for 100 shares, we need 200 shares. And then they won't agree straight away. Correct? It is just like how you negotiate salary in a job interview. Both the people, the other side also, has put some value for your candidature. Correct? You will definitely talk good about you. They will definitely tell you why they can't pay you more salary. So both the sides, one side is trying to overvalue itself, another side is trying to devalue the candidate, and then finally negotiation. Right? I don't think in articleship you guys have this experience of negotiating stipend, but tell me in real world, if someone is asking for say 10 lakh CTC and the other guy is offering only 8 lakh CTC, on what basis is he asking 10 lakh? The candidate is asking 10 lakh. Suppose you are the candidate, I'm the HR manager. Okay, nice role, easy job. On what basis you are asking 10 lakh? On what basis I am quoting 8 lakh? There should be some calculation that I have done, some calculation you have done. Same here. On what basis they are asking 2:1? Because they believe there will be synergy gain, because they believe their wealth should not go down. Tell me on what basis a new CA is asking 10 lakh today? What is the data that he has that he thinks is worth 10 lakh? Correct? Comparison. And why am I offering 8 lakh then? The HR manager, why are they offering less than 10 lakh? To save money, budget constraint. I also know that there is some other CA who is ready to accept at 8 lakh. If you have done that market survey, I would have also done that market survey. Correct? Unless I find some great quality in you, which is worth that extra 2 lakh, I will definitely bargain very, very hard. Correct? So any bargaining, 0.8:1 and 2:1, why is it so far away? It's because everyone, the candidate is overvaluing and HR manager is trying to undervalue. When you go to the interview, first sentence itself that they say is to bring you down from your 10 lakh rupee. Actually, your candidature doesn't fit us, our requirement, but still we are willing to offer. That sentence is only to tell you that you should be thankful to us and not other way around. But you can't say this dialogue when you enter. I don't think your company is a good company for me, but still. So they have this advantage over you. Correct? This is exactly what happens. Who will win the negotiation finally is the one who has the upper hand in the argument, and also depends on demand supply. If you have 10 other company offers in pipeline, then you won't accept for less than the value that you have assigned to yourself. And they also know demand supply gap. So both of them would have done some background survey. Same here also. Blinkit would have met some other companies other than Zomato saying you take over us. And Zomato also would have checked with 5 other companies similar. But in CA, one CA, another CA, you can have a comparison. But companies getting exactly comparable company is difficult. You may not get another exact like Blinkit. You will get, but that is either on the upside or downside. But a newly qualified CA is a newly qualified CA. So comparison can be done. Understanding from its high point. Okay. Today, if you check its price to book value and check what was there a month ago, quarter ago, year ago, then you will get to know the difference because your book value won't change. Anyway, face value of the share you won't change. Reserve is based on last year balance sheet. So, and it is a very good company, healthy company, old one. They're into both EV, non-EV, regular auto, accepted everywhere. Tata has a good brand value. They're into less than 10 lakh car segment, acceptable by everyone. Lot of other good factors in favor of them. Not as big as Maruti Suzuki, but definitely a good player in that industry. So many people now are giving very strong buy recommendation on Tata Motors. The main reason is a good company whose price to book value has come down, and from its good highs it is down almost 30%. That means you are getting a good item at 30% discount, mainly because of all of this. And car sales weren't great in the last quarter. So one of the indicators, like how everyone checks P ratio, people check DPS, people check EPS, and before buying on that day they check price to book value ratio, and they compare with similar companies and compare historical price to book value. And if it is very near to its book value, or at least if it is lower compared to what it was many years, then it's a good point to buy. This is learning input, not buying input. Clear? I already have Tata Motor share and I am sad because of this. Is this clear? So you buying today is not based on my advice. This is to read and learn only. Very important key ratio that people check. That is what I'm trying to tell you. Price to book value ratio is how what they speak. PB ratio is what news anchors say. So important to know. Chalo, done. 55 and 40, 120 and 32. Now basic data ready. Come to sub question A. Calculate the swap ratio, and swap ratio is based on 3 factors and the weights are also given. Please start now. Swap ratio is based on 3 factors. Start writing. Swap ratio is based on 3 factors. Line by line. Go to the question. What is the first factor? Earnings. Correct? First line. Swap ratio based on EPS is equal to, you have done the calculation just now. Now please don't give wrong answer. Efficient Limited will continue. They are buying Healthy Limited and we are taking EPS. Should I do 20 by 5 or 5 by 20? You are Efficient Limited, you are buying Healthy Limited, their EPS is 20, your EPS is 5. Is EPS a good indicator or a bad indicator? Good indicator. That means it should be 20 by 5. I know in your mind big number, small number is set. That is wrong. I've been saying this again and again. I know why you said 5 by 20. It's not big number, small number. Do not register that thing in mind. They have 4 times better earnings than yours. Why will they accept less? First of all, 20 by 5. Next line, which is the second factor. Exchange ratio based on book value. Your book value is 40. Their book value is 32. 32 by 40. 0.8. Remember, we have to then assign the weights. One more exchange ratio. As per question, it's on market price. Their share market price is 100. Yours is 50. Theirs is better. That means it is 100 by 50. 2:1, which is written as 2. If they simply say simple average, add 3 divided by 3. But now they have given weightage, therefore swap ratio is equal to, tell me what's the calculation, 4 into 40%, correct? That is a weightage for EPS, plus 0.8 into 25%, that is a weightage of book value, and 2 into 35%, that's the weightage of market price. Exchange ratio is 2.5 is to 1. That means for every 1 share held in Healthy Limited, you will be giving them 2.5 shares. If you want, write that sentence. Otherwise, anyway, question was simply swap ratio. For your understanding, if you want, for 1 share of Healthy, Efficient will issue 2.5 shares. Sub-question A was not only this. They wanted one more thing. Calculate promoters holding percentages after acquisition. Now tell me, how many shares in total Healthy Limited has? 7.5. Out of that, 5 lakh is with promoters. Now that 7.5 into 2.5 will give you total number of shares to be issued, and your own 10 lakh will continue. So 10 lakh plus 7.5 into 2.5 will be total. In that, those promoters who are holding 5, even they will get 5 into 2.5. And your company also has some promoters, but these 4.75 will not get any extra. These will stay at 4.75 only. Hope you're following what I'm saying. Start. Total promoters holding in the merged firm is equal to, tell me, your own promoters will hold 4.75. For that, please don't multiply anything. But the promoters of Healthy, those 5 lakh shares, we will allot them 5 lakh into 2.5. If you get confused, then put one bracket here. This is only 5 lakh into 2.5. For your own shareholders, you won't issue 2.5. Total will be 17.25. Now, as I told you, legally you may not call them promoters, but for all practical purpose, they will continue to be important people in the new company. What is the question? Promoters holding after acquisition, and they want promoter holding as a percentage. That means you should also find out total number of all shares of the merged company. How to do that? 10 lakh of Efficient will continue, plus the 7.5 Healthy will be multiplied by 2.5. So promoters holding in percentage will be this 17.25 divided by your own 10 lakh plus 7.5 into 2.5. Anybody? Total number of shares? 28 lakh 75,000. Since I want in percentage, into 100. Post merger, promoters holding will be 60%. For this, there is a slight detailed class note I'll dictate once the sum is fully done, because this doubt someday will come. Should we still call those promoters as merged entity promoters? Legally, no. Practically, yes. I'll dictate once the main answer is done. Did we answer sub question A? Calculate swap ratio, done. Promoters holding after acquisition, done. Sub question B. What is the EPS of Efficient after acquisition? By the way, I don't see any synergy gain story in the question. This you can try now. Give a try. Sub question B. EPS of the merged entity is equal to I think in our first table we have done EPS, so we can get EAT pre-merger of both companies individually, and there is no synergy, so it will be addition of those two. And number of shares just now you did. In lakhs, are you getting 200 lakh numerator by 28.75 shares, approximately 6.95 or 96. Done. Is sub question C. What is the expected MPS and market capitalization of Efficient after merger, assuming PE ratio of Efficient will remain unchanged? Go to the question. PE ratio of Efficient was 10, and if you have calculated EPS now, it's easy, just multiplication. And they want market cap. Be careful when you're doing market cap, you have to take merged firm number of shares multiplied by market price per share. Start. Sub question C. MPS after merger will be, just now you have done EPS, that into, they said P ratio will remain same, so I can take into 10. That means it will be priced at 69.56. But they also want the market cap, which is total number of shares after merger into this, so it will be 28.75 into 69.56. I think some rounding of difference around 2000 lakhs you get. MCQ pattern, if you have 2000 and you are getting this number, what's on screen, you tick 2000. Yeah. Both options won't be there, don't worry. And they should also give Excel sheet to you if they want 100% accurate figure. Done. Sub question D. I think you know this term first of all. Free float market cap. What is free float market cap? Other than promoter holding, which is what you and I can buy. What was the holding of the promoters post merger? 60%. That means 40% of the shares will remain free. That means in Calcifast, 28.75 lakh into 40% is free float shares, correct? And that if you multiply by 69.56, that is one route. Or this 1999.85 on that directly, 60% is with them, balance is with public. That way also you can get. Sub question D. Those who do not know, make a note of this line. Those who know can skip this line. Free float means number of shares available in the market for trading. Basically where you do not have this lock-in period restrictions, promoter holding, that is freely available in market. That is, in this case it is 40%, or out of total promoters, if you take out, balance is in public. So 28.75 into 40%. I think what is there on slide is a long way of doing. Free float market cap is 11.5 lakh shares into 69.56, around 800 lakhs. One thing you should understand, all the drama that you see in stock market is only the free float drama. Lot of shares of these big listed companies are held with family, friend, big mutual fund companies, insurance companies, banks, foreign investors who don't even dilute, which is not free float. For it to be floating easily, they should sell off. Most of it is no. Today, just check any big company, you check what is their holding percentages. Most of the big companies, majority will be held. It's not available free. So what you see Infosys shares available is only after taking out the uh, promoters holding. Yeah. So now tell me, if promoters decide to dilute, as of now they have 60%. If they say 10% of our holding will be made public, I mean we will sell off. What happens to the stock price that day? Demand supply difference, correct? Suddenly the supply will be more. Now all this, now 60% holding, in that if they dilute 10% also, which is a very big number. That day there may not be so many buyers, but so many sellers they want to dilute. This is why they put the restriction. I told you in the Blinkit case also. Blinkit promoters had 2 years lock-in. One danger if you're holding Zomato share is if it is very close to that 2 years lock-in period, high chances that the very next day that lock-in period gets over and those promoters may dilute. And diluting basically means selling heavily. And when suddenly sellers are high, buyers are less, the prices will come down. So all of this uh, IPO drama that you see for first 2, 3, 5, 10 days, and a month later it will cool down, because people will then realize, okay, it is not everything available in public. A lot of promoters are holding, and if they have 6 months lock in, 1 year lock in, suddenly for no reason one day stock price will fall crazily. No quarterly results, no bad news, no audit report, no negative commentary, nothing. Suddenly price comes down, and then you check what happened in the Google news section. Then you realize some big promoters diluted the share just one day before, and it will be made public. And those who do not know, if anyone does a block deal, buying heavily, if you and I buy 10 shares, 20 shares, there is no need. But if someone buys more than, there is a percentage set by SEBI, I think it is 2%, 2.5 is it now? So if somebody buys more than 2.5% of total shares of any company, it will be uploaded on the SEBI website, and that's called block deal, and that comes as a public news. I'm just giving you an example. Assume I'm a high net worth individual and I buy 2.6% of Infosys share today. Should be a big crore of transaction. If I buy just 10 shares, whole world will not know. But the moment I buy 2.5% or more than that, it is mandatory for the company to disclose that. Yeah. And many people follow this. That's how you get these news. Rakesh Jhunjhunwala was holding so much in this company. He won't go and tell the whole world, or the company also need not. But because they cross that 2%, 2.5% holding, it should be made public. And when they sell, when it comes below 2% also, automatically it becomes public. They won't do press conference. But these HNIs, foreign big investors, mutual fund companies, again, rules are different for institutions and individuals. But whenever this block deal happens, it will be there on money control website. You type a company name. The other day I showed you, you scroll down, the block deal list will come, whoever has bought, sold more than 2%, 3%. And most likely those guys were waiting from last 3 years because there was a lock-in period. This is more like your ESOP. I think you studied this in accounting. You allot ESOP and then they say vesting period, and then you can't do anything up till that point. And if that employee wants cash on urgent basis, he'll just wait for that many days and sell it and then leave the company's job, because he was waiting for that vesting period to get over. Same thing, you call it vesting for employee, you call it lock-in period here. Therefore, before buying any share, please check whether there is big promoter holding in that company, and whether lock-in period is about to get over. And if you're buying on, say, today, 9th November, some Zomato shares, and what if those Blinkit promoters are going to dilute it on 15th November because their 2 years are getting over exactly on that day, and then that day share price falls crazily, not because something is wrong with the company, because the supply is more and demand is less. If that is happening, then you please wait till 15th, and then when they dilute, suddenly supply will be up, demand will be same or down, prices will collapse. Good day for you to buy at a lower price. Why to buy at a higher price anyway? No other change, just that dilution of ownership is happening. But tell me, will it send a bad signal if old promoters are selling immediately after the lock-in period? If company is so good, why should they dilute? That also is a reason why share price fall. One is the supply side more. Second, if promoters are not happy, something is seriously wrong, and they know more than you. They're inside the company, you are outside the company. So many people think something is wrong, so let me not buy it now. May not be true that promoter is diluting, because maybe he wants to diversify, he wants money, he is planning some other startup, he wanted some fund, maybe everything is good in the company but he wanted cash that day, so he may be diluting, and they won't put a tweet why I am diluting. So it's all speculation by analysts. They are diluting. Some people think it's because of company reason, some maybe because of personal reasons, and you will never get their actual reason. It's all speculated reason on the uh, social media. Yeah. One such thing, those who are interested, Rakesh Jhunjhunwala, when he was alive, he was holding a lot of shares in Titan, one of his favorite stocks. So whenever he buys more than 2%, goes below 2%, used to come in the news, and he was open. He was available for all the TV channels for interview and this and that. So he used to disclose that I am holding, I'm not holding, etc. But like him, not everyone wants to disclose. Not everyone comes on TV. Many people used to buy and sell Titan based on whether he bought or not. So the day you get to see, this used to be the headline in CNBC. Rakesh Jhunjhunwala added 2% more in his portfolio from Titan. Share prices would go up that day. Those who know, Titan is Tata's wing. So like this, not everyone who owns that more than 2% will come out and say in public, but you can find it on SEBI website. Yeah. Right. Question 11 is too big to do now, but we can do one more smaller sum. Have you done practice problem 2, page 158? Next sum is on demerger, which I cannot start now. This is only for tomorrow. Practice problem 1 and 4 we did, and one more we did today. So 2 we can do now. Small sum we can do in the time that we have easily. Yes. Page 158. Given the following data for you. Yeah, sorry. But we'll do one thing. I'll do this sum and dictate the note tomorrow, because if I start that note now, then this sum will be half done. Yeah. Remind me tomorrow first thing. The note for that calling promoters as promoters. Do one thing. Leave about 5 lines. And remind me first thing tomorrow. Yes. Practice problem merger 2. 5 marks question. Given the following data to you: net earnings, which is PAT, day limited, night limited, number of equity share, with this you can get EPS, P ratio, with this you can get MPS. Day limited considers taking over night limited by, underline, paying 55 crore. That means you know the purchase consideration. Considering that the market value reflects true value, it is considering both these options. First, we'll do the takeover by paying cash. This part is easy. Second, we will do takeover and we will not give them cash. We will give them 55 crore worth shares. Instead of cash, we'll give them shares. You are required to calculate cost of the takeover and suggest which one is better. And when they're using the word cost of the takeover, that means they're asking you to work it out from day limited's angle, because day will take over night. Yeah. First one should be easy. Tell me how much is the cash you're planning to pay. 55 crore. And you're taking over the company called Night Limited in Calci. How many shares they have? 7 crore. Sorry, 7 lakh. And read the information after this. They believe that the market value reflects its true value. That means I should find out market value of this company. One way of doing, you first find the EPS, multiply by P ratio, that will give you MPS per share, then you multiply by number of equity. But I think we are doing too much of multiplication division. We can do one shortcut also, I am thinking. Tell me what's the shortcut that I can do. I repeat what I said. Okay, you start fresh in Calci, you'll understand what extra circus we are doing. If I do 3.5 crore, better you do 350 lakhs. Divide by 7, you'll get what? EPS. And that if I multiply by P ratio, I get MPS, that is per share. That again if I multiply by 7 lakh, I'm getting market value. Instead of dividing and multiplying, I think I can directly do one shortcut. Tell me what is the shortcut that I can do. PE ratio into MPS is 1 share. That means if I do PE ratio into total earnings, that should give you total value of all shares put together. Guys, you first divided by 7 lakh and then you multiplied by same 7 lakh. I'm saying take out 7 lakh in both. Then you're simply doing 3.5 crore into 15. If you don't like shortcut, then you know what to do. But this is an easy way to do. I quickly repeat. We are doing 3.5 crore. Divide by 7 lakh. And then we multiply by 15. And then we again multiply by 7. The 7 lakh got once divided and then got multiplied. I'm saying cancel that straight away. Then you can directly do 3.5 into 50. If you have done, what's the number that you're getting? 52.5 crore. But how much cash are you paying them? 55 crore. That means you're paying little extra. What's the difference between those two? 55? That becomes your cost of taking over. Because you're paying more cash and taking over a company whose value is around 52.5 crore. You're paying little more. That becomes your cost. Remember, first class merger and acquisition, there was a slide, cost for purchasing company, benefit to the vendor company. You are paying them 55, but you're taking the company worth 52. The difference is your cost of the merger. Yes, start. Sub question A. Cost of takeover is equal to line by line. First, cash paid 55 crore minus total value of Night Limited long style of doing 3 crore 50 lakhs divided by 7 lakh is EPS into 15 times PE ratio. This will be market price of 1 share, that into 7 lakh shares. This is what I was trying to tell you. 7 lakh you can cancel. 52.5 is it?
Yes.
What was the number? 0.5. 5 crore. That means you're paying 2.5 crore extra. This is the cost. If they ask you benefit to Night Limited shareholders, this is the benefit, because they are giving away 52.5 crore worth their shares and taking 55 crore in cash that day. This is always easy because you know what is coming to you and what is going from your pocket. But second one is where the challenge is. Now tell me, this is done. Takeover is funded entirely by stock. We are taking over their company, and we have decided that it is worth 55 crore, but we are not paying cash, we are issuing our shares to them. Correct? Start. Sub question B. If takeover is by issuing shares line by line, total purchase consideration. Remember one thing, 55 crore is not at negotiation. That is decided. Question is whether we should give cash or should we give shares. Able to follow? Is equal to 55 crore. Tell me if Day Limited has to issue shares to them. Do we know the share price of Day Limited, by the way? No. We can calculate that. Yeah. Next line. Market price of share of Day Limited is equal to 5 crore by how many shares? 10 lakh into P ratio 20 rupee. What's the number? 1000 rupee. Now tell me. We agreed 55 crore, but we will not give cash. We will give our shares, and our shares are worth 1000 rupee. That means number of shares to be issued. Number of shares to be issued by Day Limited to Night Limited shareholders is equal to 55 crore. Be careful with zeros. By 1000 rupees. I'll wait. Go slow and tell me the number. 5,50,000 shares. Am I correct? If you're doing everything from beginning in lakhs, then 5.5 lakhs. Please read in the question. Is there any synergy gain that we are expecting? No. That means value of the firm after merger will be simply addition of Day Limited valuation plus Night Limited's value. Correct? EPS won't change. There is no plus to be done. Next line. Post merger value of which company will continue? Day Limited is equal to, tell me, how many shares Day Limited has? Sorry? 10 lakh shares. And what is their market price? We just now did 1000. And how many shares we will allot to Night Limited? 5,50,000. But there is another easy way of doing this. Did they mention anything about the P ratio? No. Can we even do this way? Net earnings are with you. P ratio is with you. Guys, again we are doing double multiplication, I'm thinking. In Calci, just do this. How much is net earnings of Day Limited? 5 crore. That if I multiply by P ratio, I will directly get the total market value. Otherwise, again we have to do 5 crore by this into this into this. You saw we did that long route once. Hello? Guys, if I want merger value, post-merger value, I have to take total number of share into MPS plus total number of shares into MPS. Instead of this circus, we already have total earnings. So do this 5 crore into P ratio is 20. This should give you total market value. Plus, what about this? 3.5 crore into their P ratio is 15. Take time and do it. This will, I think, be a big number. 150? 2.5, and this we are doing in crores. Correct? You can do it in long route. Find out per share, multiply by shares. You will get the same. You saw already this. Correct? This will be the value of the merged entity. In this, how much will be the weightage of the shareholders of Knight Limited? Remember that alpha, total value of the company into percentage holding of the new people divided by total, right? Out of this, continue. Out of this value of shares held by shareholders of Knight is equal to 152.5 crores multiplied by, if you remember in the first class, alpha will be, how many shares are we allotting them? 5,50,000 shares, correct? Divided by total number of shares of this company will be your own 10 lakh plus 5,50,000, 15,50,000. If you remember, this was there as alpha in that slide. I think you have made a note also of all these slides, initial examples. Numbers are in crores and lakhs. Don't get confused. Take time. $152.5 crores into 5,50,000 by this. Anyone has? 54.113 crore, correct? Because we started with crore values. And how much are we? How much was the first option? 50? No. 52.5. But now it is worth 54.13. By the way, they have asked you last line, please see, you are required to calculate the cost and suggest, correct? Hello? 54.13. Therefore, cost of merger is equal to 54.113 minus 52.5, right? What's the number? 1.613 crores. Yeah, all are in crores. We are not giving them 55 crore cash, by the way. That was the valuation done. We gave them shares. How much was the cost in the original option? 2.5 crore. But now the cost is only 1.613. Just a second. I'll just finish. One last line. I'll just finish and clarify. Since cost of merger is lower in share exchange option, comma, the same is preferred. Okay, by the way, the doubt is why are we taking 52.5? Read in the question after that first table, what did they say? Day Limited is considering taking over Knight by paying that amount, considering that the market value reflects their true value. That means their true value is only 52.5. But I am giving them shares based on my valuation of 55 crore. In first option, I paid 55 cash. Therefore, I did 55 cash paid versus 52.5 value taken. Now, value taken is 52.5, but I am allotting them shares. Post merger, the value of the shares that will be with them is only 54.113. I never paid 55 in second option. I did valuation at 55 and then gave them shares, and then that is worth only 54.113. 52.5 is their original value. This we did in the first line itself, right? See this, correct? When we were paying cash, 55 was going outright. Now 55 was the value, but we did not pay cash. We allotted shares. And post merger, those shares are worth only 54.113. The difference is my cost. Done.